Commissioner, we're ready whenever you are.
Can everyone hear me?
2 minutes.
Get online first.
I'll click the view so we can see everybody up in the right corner. There you go.
Can everyone hear me?
Yes, we're waiting for YouTube to kick in. Commissioner, we're still trying to go live on YouTube. Please stand by for just another moment or two.
Okay.
Madam Chair?
Member Messina.
Yeah, I just wanted to give you a heads up. I have to be somewhere, so I'm going to part from the meeting at about 11 or so. Sorry.
Steve, will we be left with a quorum after that?
Yes, we will.
Okay. Thanks for letting us know, Mike.
Yes, of course.
To that point, Madam Chair, at 10 o'clock, I have to meet with a reporter for the New Mexican. And so I'm gonna have to step out just for a little bit.
But you'll be back.
I'll be back, yeah.
Madam Chair?
Yep.
Yeah, if necessary, I can stay on at least until Nick gets back, so you don't have a problem with your quorum.
That sounds good. I'd appreciate it.
Since we're waiting, I have a question for somebody. On the item H, what's the current amount of the current one-year contract? Does anybody know?
Commissioner, we are ready to begin when you are.
I think.
She had a question.
Treasurer had a question.
I think I can.
Go ahead, Ben.
Treasurer Montoya, we've had a trial version of the Strategas. I mean, it's been the full service, but it was a trial price. I don't recall what it is, but the run rate that we've put in this contract is about the same as we've been paying.
Vince, the current rate is 85,000 a year. This is the trial rate.
Thank you.
All right, let's go ahead and call the meeting to order, and we'll have Andy take a roll call vote, please.
Governor Lujan Grisham. Commissioner Garcia Richard.
Here.
Treasurer Montoya.
Present.
Secretary Props.
He said he
Secretary?
can't hear anything. I see him on the line. Let me just let him know we're starting and to restart.
Mr. Jennings. Mr. Lavender.
I'm here.
Mr. Summer.
Here.
Mr. Messina.
Here.
Mr. Tejas.
Here.
Ms. Allen. Mr. Bingaman.
Here.
We have the secretary. Oh, okay.
I mean, he's here, I can see him, we just can't hear him, and he can't hear us, I guess. Do we have a quorum even without him or no?
Madam Chair, we do have a quorum.
Okay, let's continue with the meeting and hopefully he can restart his system. If we could please turn to the approval of agenda.
I move approval of today's agenda.
Second.
Okay, we have a motion by member Lavender, I believe a second by member Summer. Any discussion on a motion to approve today's agenda? Can we take a roll call vote on approval of today's agenda?
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Mr. Lavender.
Yes.
Mr. Summer.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Mr. Bingaman.
Yes.
Secretary Props.
Yes.
Madam Chair, the motion carries 8-0.
Okay, thank you. Go down to the approval of our March minutes, March 28th minutes. Do we have a motion?
Motion to approve.
Second.
Motion by Madam Treasurer, second by member Lavender. Any discussion on the motion to approve our March minutes? We could have Andy take a roll call vote, please.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Props.
Yes.
Lavender.
Yes.
Mr. Summer.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 8-0.
Good. Okay, if we could turn it over now on agenda item 2A to our State Investment Officer, Mr. Moise, for his briefing.
Thank you, Commissioner. Good morning, everyone. If you would please take a look at the State Investment Officer's briefing, which you have in your materials. We'll begin with item A. Total distributions from the funds for the last 12 months have been $1,248,686,000. $778,000. The land grant permanent fund contribution received from the state land office as of March, and remember we have a 90-day lag on these inflows, $233,161,000,000. Net asset value as of Friday was $43,083,000,000, and I'm rounding numbers. New Mexico WTI oil price as of Friday was $73.84 per barrel. The differential between New Mexico and the WTI price is about $2.95 discount. A year ago, the price was $103.44. It was a $2.50 premium to WTI in April of 22. New Mexico rig count a year ago was 95, and as of Friday, that number was 104. We don't have New Mexico natural gas as of this morning, but the U.S. price as of Friday, $2.20 per MCF. It was $6.88 a year ago. Moving on down the page of the briefing, if you would please go to item C, council matters. You'll see the meeting dates for the investment committee and the council in May. May 16th for the investment committee, May 23rd for the council, and the location of that meeting will be determined at a later date. Kathy Allen was not able to be with us today as the chair of the governance committee, and she would like to present comments and requests regarding the council code of conduct next month. That's item C2. And then under D, operations. As we've mentioned before, we've been looking for a couple of analysts, one for the real return portfolio, another for our private equity investments. We have some excellent potential candidates that we're considering. We also have a candidate for the investment strategist position that we are considering seriously, and we will let you know how all of those pan out next month. Today, we're going to have a very interesting presentation from Dawn Iglesias, item D2 regarding fund inflow projections and how those will relate to staffing and budget needs in the future. Vince will also be commenting on the staffing needs. Item E, client and legislative matters. Charlie, what comments do you have on those, please?
Thanks, Steve. Madam Chair, very brief comments about client activity. We are at 25 clients currently with $1.8 billion invested across 46 separate accounts. A reminder that these are long-term investments with an investment horizon of at least a year. Shorter-term investment should, of course, be over at the Treasurer's Office and the LGIP. We will be taking on a new client before the end of the fiscal year, North Central Regional Transit District. That joint powers agreement was actually approved last year, but they are now likely to put money with us about $1 million in June. We're also losing a client. New Mexico Higher Education Department has pulled about $2.9 million from our accounts at the end of this month. We are asking for a reason. We haven't heard back yet. Discussions are ongoing with one potential new client from eastern part of New Mexico. And we've also, we're setting up some meetings with some folks in Curry County that are also interested in putting some money to work in our long-term investment pools. Madam Chair, that's all I have, but glad to take any questions.
Madam Chair?
Member Messina.
Yeah, I'm sorry. What time is the investment committee meeting and the state investment council meeting in May?
Madam Chair, if I may, the investment committee meeting on May 16 will be at 1:30 here in our office. The council meeting will be at 9 o'clock on May 23rd.
Thank you.
And Madam Chair, if I may, just one more matter. The chair of our investment committee, Mr. Lavender, has a comment.
I'd like to bring it to the council's attention that our charter calls for us to have 5 members of the investment committee. We haven't had that many for a while. We're really lucky that Mary Roman has agreed to serve on the committee with us as an advisor. If you look in your packet, you'll see her pretty impressive list of experiences and qualifications. We're thrilled to have her, and she's sitting at the end of the table here in the office. And Mary, welcome.
Thank you very much. It's a pleasure to be here this morning.
Thank you.
Thank you, Commissioner. That concludes my report.
Welcome as an advisory member, Mary. We're glad to have your expertise join the investment committee. I just wanted to, before I open it up for questions, draw attention to a item that Steve shared about rig count as compared with price per barrel, because, and I'm not sure if Don has seen something similar, but back when I was in the state legislature, we used to watch rig count sort of climb and fall with price per barrel, and now we see it flip. So a year ago, the rig count was lower, but price per barrel was higher. And I think that's a function of what we're really observing at the land office. It's no longer tracking with price per barrel. I think that has a lot to do with the break-even price in New Mexico. You know, a lot of companies, our lease sales kind of speak to this. A lot of companies are really increasing production, even though price per barrel has not kept pace. So we've just noted the 12th month in a row of receipts over 200 million per month at the land office. Are there questions for Steve? Okay, hearing none, we're going to turn it over to Vince.
Thanks, Madam Chair. Good morning, everyone. Very good to see you all, and thanks to all of you who came to the room. Very good to talk with you before the meetings. So out in the economy and out in the markets, the Fed wants one more 25 basis point increase to the Fed funds rate. They'll do that in May. That's the market expectation, and indeed our expectation here internally. And then they intend to hold rates at that level, which would be a top of 5.25%, so a range of 5 to 5.25%. They intend to hold that rate for the rest of the year. The market doesn't believe them. So if you look out into the futures market for short-term rates, the market actually thinks the Fed will start cutting in July after this rate cut in May, or rate increase in May, and pull rates down at least a full percentage point by the end of the year. So we've got a difference of opinion between the Fed, who controls rates, and the market, who at the end of the day handicaps these things and makes investments based upon it. So we'll see. You know, I think behind both the Fed and the market's opinions is that Fed fund increases work on a lag. So they enter the economy fully over a period of 12 to 18 months. Historically, that's the way it's worked. So immediately after a Fed fund hike, there's immediate impacts. But in order to work its way all the way into the economy, it tends to take 12 to 18 months to fully get in there. If you go back 12 to 18 months, the Fed was just beginning to lift interest rates. I think they were at 50 basis points a year ago, maybe 75 a year ago. So most of the move from basically zero to 25 basis points, most of that move from there to 5.25 has not fully worked its way into the economy. So the Fed thinks the economy is strong enough to handle 5% rates, and for that full measure to come into the economy, and intends to hold those rates till the end of the year. The markets don't think that's going to be the case, and the Fed's going to be forced to cut. So we'll keep an eye on that. And it's pretty interesting now. I've not seen a divergence by 100 basis points between what the market thinks and what the is indicating they want to do. However, the rate hikes, at least in part, have inflation headed in the right direction. We ticked 9% at an annual rate at the top. We're down to about 5%, and it's heading in the right direction. We still are expecting a recession this year, and we think that takes inflation back down to the Fed's target of 2%, maybe even below, depending on the depth of the recession. So, as we said last month, when inflation takes off and the Fed starts fighting it, the Fed wins. And indeed, the seesaw is tilted toward the Fed here with last inflation print at 5% and headed lower. So we're very, very glad to see that. As we talked about last month, inflation is just a horrible tax on people, and the Fed needs to be very aggressive in fighting it, and that's happened, and it's working. We're not in recession yet, but we still think that's coming, and that ultimately will beat inflation down. With respect to the markets, stocks remain stubbornly high priced. The earnings yield on stocks, which is just simply the price to earnings ratio flipped upside down, is still about 5%. We're still getting 4% or so in the short end of the interest rate curve. So you can either have stocks at 5% earnings yield, or you can have a 2-year Treasury bond around 4% cash yield guaranteed from the U.S. government. So that's not a particularly good trade. We're far more interested in the cash yield than we are our stocks at this level. And been keeping our eye on it. Also, longer-term price measures for stocks, they hit just nosebleed territory at the end of 2021 at a 29 Shiller PE ratio, the long-term ratio that we use. That's down around 26 today, but still relative to history, anytime the market gets above about 25 on the Shiller ratio, future 10-year returns, 10 years, the forward decade worth of returns from the stock market generally is well below average. So we still think we're quite expensive in the stock market. Let's see. We haven't seen much in the way of write-downs yet in the private equity portfolio. We think that's a function of stocks holding up pretty well here against the Fed interest rate increases in a slowing economy. We have, however, started to see write-downs in core real estate, and that's consistent with the interest rate increases. And we're keeping our eye on a wall of refinancings that's coming for the big core real estate area. A number of these companies are going to have to start refinancing buildings and other investments here over the next year, and we're trying to keep our eye on that. And so I think that's it for economy and markets. Madam Chair, Steve asked me to comment on staffing needs. When Steve and I started, the funds were about $13 billion in size. Today we're around $43 billion, and I have one fewer investors on the investment staff than we had then, and there's fewer folks in the office all total than we had then. We've got projections, we've got models projecting out potential inflows into the funds combined with investment returns that could push the value of our funds over the next decade to $100 billion, so more than a double from here over the next decade. That's going to take a materially larger investment staff to be able to handle a fund size or funds of that size, and likely a slightly different structure than we have today. So we're working very hard to fill the 2 open analyst spots that we have. And we will be opening probably next week or the week after, depending on how fast the State Personnel Office can process our request for another investment strategist. That'll fill me up, at least for now, on investment strategists and get us back to what I think maybe is par on investment analysts, those 3 people. We are really trying to get this done by September, which is when Brent puts his budget in. And at that point, we'll be asking for more positions to fill out the investment team and possibly more positions outside of the investment team. Next up for us is an operations person. As we've added so many more private investments into the portfolio, Brent and my group have sort of shared the operational load. we need to fix that structurally with at least one operations person to handle a multitude of tasks right now that Brent's group and I split among our folks. And then the next few ads will be very much be analytical support for our asset class directors. So more investment analysts in the asset classes, particularly the private asset classes, private equity, real estate, real return, and private credit. So that's the nearer term staffing needs. We do have a longer term plan that calls for significantly more investment staff and somewhat of a restructure to try to get in place and try to get ahead of this wall of cash, a wall of money that's coming that will need to be invested over the next decade. It's a great problem to have, and really looking forward to rolling that out. But I think, Madam Chair, that's all the comments for markets and the economy, and just a brief preview of staffing needs.
You heard it here first, folks. Wall of cash. Questions for Vince?
Commissioner, this is Steve, if I may. Just adding to what Vince has explained, as you could imagine, we're going to need very strong support from the council as we add staff, as we need to properly compensate the staff, not only on the investment side, but also on the accounting side and elsewhere in the office. And we will appreciate all the support you can give us. Thank you.
It looks like we have a question from the Secretary.
Good morning, Madam Chair, members of the council. I've been meaning to say this for what it's worth when this topic has come up at previous meetings, but I want to make very clear my strong support for dusting off that long-term plan that Vince talked about and having the council take a look at long-term, medium-term staffing needs, but also compensation needs. The legislature and the executive have obviously asked a lot of the council in terms of the money that's going to be coming in over the next decade or so. And I think this is the perfect time to go back to the legislature and the executive and say, we're going to need some support from them as well. So I just don't want to belabor the point, but I do think it is time for us not only to look at the staffing levels at council, but also compensation for professionals, and look at ways to perhaps get out of the box that we are in with SPO in particular, and possibly even DFA in terms of compensation, and giving some authority and flexibility to the council to set compensation rates for our investment and accounting professionals. Thank you, Madam Chair.
Well said, Mr. Secretary. Further questions for Vince? Hearing none, I'm going to turn it over to our representatives from RVK. I'm not sure if that's Matthias or Marcia.
Okay. Thank you, Madam Chair and Vince, for the comments. First up, we have a February flash. It doesn't include the private markets data, given that this is not a quarter end period, so we'll be pretty brief. Vince already mentioned a lot of what's been driving the short-term returns. I think as you look at those numbers starting on page 18 of the meeting materials, that's your one-page overview. Lots of red numbers for the month, although fortunately January and March were sufficiently positive to produce a overall positive return for the quarter. And this is true not just for your risk assets, but also for the more defensive assets. Nice surprise, or at least a nice change in terms of pace for defensive assets and fixed income. Last year, of course, was a pretty tough period. But as Vince mentioned, there's some anticipation or expectation also of rates to moderate some, which should be further tailwind. So I'll stop here just in just a time. We have a lot of material to cover. Marsha will make a couple comments on the fund performance, and then we'll move forward.
Page 20 of your materials looks at the performance for February. Again, as Matthias said, this is does not include private assets. For private equity, real estate, real return, those values are held at or that returns are held at 0 in interquarter months. So this is very much preliminary. But on page 20, you see for the month of February, you were down 1.34, moving your fiscal year to date return down to just over 3%. As Matthias mentioned, January and March were positive. We can bless you. We can report that March was performed very much like January. So you're at the end of March, you were pretty much where you were at the end of January. So February was sort of a lost month for you. So at the end of the first calendar quarter, you were where you were at the end of January. We do have composite information on page 26, again, only for the publicly traded portfolios. So U.S. equity, which as for the month of February was down, as was non-U.S. equity. Core fixed income for the month was down, but your non-core portfolio was positive. And again, your private assets are not valued until the end of March. So with that, we're happy to answer any questions, but that's preliminary data.
Questions for RBK? Seeing none, we're going to move to agenda item 3A, investment matters, and turn it over to our investment committee chair, Member Lavender, for his report.
Thank you, Madam Chair. I think what I'd like to do is be enlightened here a little bit. If I understand correctly, although 3C says vote, my understanding was we were going to cover it today and then vote next month. Is that correct? Because of the significant amount of material, so let me know what's going on.
Sure. At the last meeting, the chair asked for these bigger policy decisions if the council could have, sort of 2 bites at the apple. We're absolutely prepared to brief this and then come back to you in May for a vote.
Okay.
But if the council's ready today, you have that option.
Okay. I just wanted to double check and see what was there, and we can get the sense of the council as we move on from there. This was a fairly lengthy investment committee meeting last week and covered a lot of material. You'll get the rest of the council is going to get a chance to see it today. The voting items you can see are very clear. So rather than take up time talking about what we have, let's just move forward. I'll turn it back over to Vince, and we can go from there.
Let's first, Madam Chair, maybe Dawn's presentation.
Okay, sounds great. Dawn, are you ready?
I am, Madam Chair. Good morning, committee members. I'm going to be going over the oil and gas inflow presentation starting on page 51 of your diligent book. I'll be going through several charts that are in this presentation, so I highly encourage you, if you have your diligent book materials ready and available and able to follow along, I'm going to point out several graphs and charts in this, and it's going to be really helpful if you're able to look at those along with me. So starting here on page 51, this slide is providing an overview of how our various funds receive various oil and gas inflows. So as you all know, oil and gas is our primary source of contributions for our largest funds, and the amount of oil and gas revenue that each fund receives, it really depends on 4 key things. 2 of these we've talked about before: how much of the commodity is produced, and then of course, at what price is that commodity produced. But given the sources of these inflows, what also matters is where that commodity is produced, for example, whether it's on state or on federal land, and then on the statutory formulas for distributing those different types of revenues. So when we're determining our inflow estimates, we're not just looking at future price and production, but we're also accounting for the specifics of how each fund gets its own share of oil and gas revenue from these different sources. So because we have a few new council members, I'm going to go through each of these briefly for the 4 largest funds under our management. Starting at the top with the Land Grant Permanent Fund, as you all know, this receives royalties for mineral production, specifically on state trust lands. Now, there's a handful of minerals that are produced in the state, but oil and gas makes up about 99% of the contributions that come in for the Land Grant Permanent Fund. Now, for the Severance Tax Fund, historically, it has received a portion of the severance tax revenue that is not used for bonding capacity. And so now in statute, that's roughly 14%. That's severance taxes for oil and gas and other types of minerals, but primarily oil and gas that's produced across all lands in the state, so state, federal, private, et cetera. And that revenue is first collected, it goes into the bonding fund, and then the Severance Tax Permanent Fund gets a portion of that that's transferred twice a year. Now, recently, the legislature has put in statutory minimums for that distribution. Currently, it's at about $24 million a year. That statutory minimum goes through 2028. And then the legislature just passed a new one that sends another minimum $92 million a year through 2033. So those are combined for about $116 million. And that's going to be in addition to any other percentage of the total severance tax revenue that the permanent fund is due from the bonding fund. So those are that together. And then the piece that really changes the outlook for the fund, for the severance tax fund, is new revenue that will come from Senate Bill 26. I'll go into some more detail on this in a minute, but essentially that bill caps how much oil and gas school tax and federal royalty revenue that the general fund can get, and sends anything above that threshold into the severance tax permanent fund. And what this could mean is some really big inflows, especially given that a new Rystad study that came out found that federal land is specifically in the Permian Delaware. So that's going to be primarily New Mexico for federal land in the Delaware. That it contains not only the most productive wells in the Permian Basin overall, but also likely some of the most productive wells in the United States. And so now that the Severance Tax Permanent Fund will be getting a portion of federal royalty revenue, that's going to end up being a pretty big deal for that fund. And I'm going to go into some more detail on that in a minute. But now on to the Tax Stabilization Reserve and the Early Childhood Funds. So both of those have a mechanism for getting school tax revenue as well. They get an amount above a 5-year average. It's going to either go to the Tax Stabilization Reserve or the Early Childhood Fund, depending on the level of general fund reserves at the end of a fiscal year. So below 25%, then it's going to go into the Tax Stabilization Reserve. If general fund reserves are above 25%, it's going to go into the Early Childhood Fund. Recently, reserve levels have been high, and so those distributions have been going into the Early Childhood Fund. And early childhood also receives federal royalty payments as well for anything above the 5-year average. And we're going to look at how those different things stack later in the presentation. But first, I want to turn your attention to page 52 of your diligent book. This is the updated production outlook. It's relatively unchanged from when we last presented this to you in November. But the highlight for this slide is that production in the state is still expected to grow over the next several years and then peak around the late 2020s, early 2030s. Now, most of the state's production is from horizontal wells. So the primary ways that production has grown in the state until now has been through increased well productivity and drilling enough new wells such that production from new wells offsets the decline rate from older wells. Now, current estimates from Rystad show about 10 to 15 remaining years of being able to drill at pace in New Mexico on our most profitable acreage. So after that point, the remaining acreage is less profitable. So the expectation is that fewer new wells would be drilled, and eventually the decline rate would outpace new production and overall volumes would start to enter a period of steady decline. Next is going to be the price outlook on page 53. The charts on this slide are price forecasts from several different sources that we track. And the real takeaway here is that no one really knows what prices are going to be next year, let alone 10 years from now. So these forecasts, what they do is reflect what energy analysts think the equilibrium price would need to be for oil and gas supply to meet their demand models. And you can see on those two charts on the left-hand side that there is a wide range of dispersion in those forecasts. And then on top of that, we all know energy prices are sensitive to a lot more than just market fundamentals alone. They can vary based on real or perceived monetary policy or geopolitical tensions, et cetera. So for our planning purposes, we use an average expectation across these various forecasts, and then we regularly update them so that we're capturing actuals and we're capturing changes in the projected prices, and we adjust our expectations as we go. Now, right now, we're working off of a long-term price expectation of about $60 a barrel for oil and about $4.50 for natural gas. And so putting that all together for inflows, if you'll turn with me to page 54, here we have run our price and production assumptions that we just went over through our inflow models that account for how each fund specifically gets its own share of tax and royalty revenue. And on this slide, it stacks together those combined expectations for contributions to the land grant, severance tax, early childhood, and tax stabilization funds. And this gives us an idea of cash in the door for the foreseeable future. Now, these estimates are what we are currently using to inform our asset allocation studies, our pacing models, and our intergenerational equity studies. And there's a few really important things to point out on this slide. So first of all, if you look at 2022, to call it a record-breaking year is a complete understatement. Total inflows were over $8 billion across these different funds. To put that into perspective, if you look at the left-hand side of that chart, the previous record was a little over $2 billion. That was in 2020. And then the average prior to 2018 was about $460 million. So last year was unlike one we'd ever seen before and could be unlike one we will ever see again. But with that being said, inflows over the next decade across the four funds, especially given new ways that our funds will receive revenue, they look very likely to exceed historical norms. So even though prices have come down from last year's highs, they are well above the average prices prior to the pandemic, and production in the state is still on track to keep growing for several years. And then again, with new legislation, the Severance Tax Permanent Fund having two new sources of oil and gas revenues, that's the yellow bars on the chart, we can see that there's a lot of potential for growth in terms, or for sustained strength in revenues into our different funds. So a lot of cash in the door, less than last year, but more than what we have been used to historically. Now, I will, of course, give the caveat, as I always do, that given price volatility, these projections come with a lot of uncertainty. There's a number of things that could make actual inflows either a lot higher or a lot lower than what we have here. But this serves as a reasonable baseline expectation and more or less a planning guide for us. And we're able to, again, update these, adjust them regularly with actuals and changes in expectations, as well as do some scenario planning. And we have some examples of that for you today as well. I'm going to turn to the next page on slide 55. This is just going into a little additional detail for the individual inflow estimates that were stacked on the previous chart. So this slide has the land grant permanent fund estimates that are updated from what I showed you in November, along with the alternative price assumptions. And you can see those on the chart on the left. So since the price outlook has come down some since the last presentation, the estimates are somewhat lower than what we presented 5 months ago. But you'll notice that we still have really good reason to expect more than $2 billion per year of contributions from or into the land grant permanent fund over the next decade if these assumptions hold. Turning to slide 56 or page 56 of your book, this shows the severance tax permanent fund. The severance tax fund also got a big windfall last year. It was $1.6 billion over the calendar year. More was deposited in that year than in the prior 20 years combined. The primary reason for that was not new sources of revenue, but actually because of a statutory mechanism that limits bonding capacity to the lesser of the current year or the prior year's severance tax revenues. So when revenues shot up this year, the legislature could only use about half of that for bonding, and then the rest went to the permanent fund. Now, for this year, the contributions from the bonding fund will come back down. That statutory mechanism is not going to send a huge windfall to the fund again. But this year's contributions are going to be supplemented by a $475 million one-time transfer from the general fund that was just approved this session, as well as those required minimums that we outlined on the first slide, and a revenue that's coming in regularly from the bonding fund. So still a pretty high compared to historical expectation for contributions this year, but nothing like what we saw last year. Now, the real potential game changer for this fund will be the new inflows into the oil and gas, into the fund from the oil and gas school tax and the federal royalty revenues as a result of Senate Bill 26. So again, what that bill is basically doing is saying any revenue that the general fund would otherwise get from those two sources that would be above FY24 levels, then anything above that level goes into the severance tax permanent fund. And so you can see on this chart on the left-hand slide how the school tax and the federal mineral leasing revenue is going to be divvied up between those three different funds: the general fund, the early childhood fund, and the severance tax fund, where anything above the 5-year average is still going to early childhood, but anything above that FY24 level, but below the 5-year average, that difference is what's going into the severance tax fund. And that makes up the yellow bars that are on the chart on the right-hand side of this. And you can see that those are pretty substantial. So if current estimates for prices and production hold up, then the size and scale and continuity of those distributions into the severance tax fund could be unlike anything that fund has ever seen in its history, and really has a significant chance to not just grow the size of the fund, but of course, most importantly, grow the size of the distributions from that fund to the general fund. Depending on those inflows, if they hold up like we think they would, and then of course, depending on market performance, the severance tax fund, which now distributes a little less than $300 million a year, has the potential to distribute over $1 billion a year to the general fund by around the 2030s. So it's really spectacular potential for the severance tax fund, and the great ability for that fund to increase its general fund distributions in the future. Now, turning now to slide 57, these are inflows for the Early Childhood Trust Fund. That fund got over $3 billion last calendar year. Current estimates show that that fund could continue to receive significant inflows, a cumulative of about $6 billion over the next 5 years. But because that fund gets an excess of an average for the school tax and federal royalty payments, the distributions to the Early Childhood Fund are expected to shrink over time as that 5-year average grows. You can see that on the top chart on this page, where the light blue line starts to increase. So the amount over that line starts to decrease. And that is going to mean that fewer inflows into the Early Childhood Fund in the future are expected, given the current expectation for a rise in that 5-year average. But even so, the Early Childhood Fund has potential to grow its distribution to early childhood programs in the state from $150 million in FY24 to potentially over $500 million by the early 2030s, again, depending on whether these inflows look like we expect and how the market performs. Now, I want to turn our attention to slide 58. During our last oil and gas presentation to the council in November, members had asked about the energy transition and what that could mean for into the fund. So first, this slide is to set some context. These charts are from JPM's annual energy paper, and they put it pretty well when they say that the future of global fossil fuel demand depends on who you ask. The chart on the right shows a variety of future oil demand projections, and you can see they are all over the place. The only thing that is consistent with these forecasts is that they expect oil demand to peak within the next decade or so. But then beyond that, there's no real agreement on where that peak is and how fast the decline could be thereafter. There are simply too many unknowns at this point for there to be any real consensus on the outlook. So if you turn to the next slide, this gives a good example of how different assumptions for the future kind of changes what that outlook for the energy transition could be. So Rystad Energy has several energy transition scenarios that we now have access to through our subscription. And you can see the kinds of assumptions that each scenario has to make, and then the differences in the outcome of those various scenarios. They make different assumptions around EV adoption, plastic recycling, and uses of fossil fuels in transportation and in stationary sectors. And depending on the assumptions you make, you can make a wide variety of potential energy transition outcomes in terms of the future of oil demand. And then, of course, along with that, the chart on the lower part of this slide shows how the different scenarios for energy transition comes with different price assumptions in terms of what Rystad projects prices would need to be in order for supply to meet those levels of demand. And that ranges anywhere from $30 a barrel to $200 a barrel. So we're talking about a lot of dispersion, a lot of uncertainty around what that could mean. So how do we put this together for the permanent fund? How do we look at that? And there's, because there's so many different scenarios, there's a lot of different ways to look at it, but some examples on page 60 of your diligent book. What we attempted to do here was take the Rystad energy transition scenarios, specifically for what their projections are for U.S. onshore production from shale and tight oil basins. And basically what this does is ask the question, what would New Mexico production look like if it followed the same trends that Rystad has in those different scenarios? And in addition to their three own scenarios, they looked at other scenarios from the International Energy Agency, what they call their announced pledges scenario. And this basically represents government's announced ambitions for climate and energy goals. And they also include the net zero scenario, which is what IEA says what it would take, what would have to happen in order to achieve net zero by 2050 and cap global temperature to no more than 1.5 degrees. And then it also has OPEC's reference case scenario in here. So again, a lot of dispersion if you look at this slide. All the scenarios have production peaking within the next decade, but there's massive dispersion on how long it would take production to peak and where production could end up by 2050. So in terms of what this could mean for inflows, if you look at the next slide, page 61, this takes each of those production scenarios and the same baseline price assumptions that we currently have for our models, and then applies that across the inflow models to give us a sense of the production risk of our inflows around the uncertainty of the energy transition. And there's a couple of things that I really want to highlight on this chart for you. First is that our baseline inflow assumption, that's the dark blue line on this chart, the dark solid blue line, that is basically the stack chart that I showed you from a few slides ago, and this is our planning guide. And that falls roughly in the middle of the different scenarios. for where production could end up in the state. So despite being pretty high compared to historical inflows, it's roughly middle of the road in terms of all of the different production scenarios for all of the uncertainties that are out there. The second thing that I'll point out is that in the IEA announced pledges production scenario, that is the dotted green line about third up from the bottom on this chart. Even in that scenario, which represents what production could look like if all governments globally were to deliver on all of their energy transition pledges, both on time and in full. And under that scenario, we could still end up seeing inflows that are above historical norms if you compare that line to the historical inflows of the solid green line. So again, these scenarios are looking at variance specifically in the production outlook. If we added price variance in the mix, I could add another 10 lines or more to this chart for you. So in some ways, it can be more useful to look at this in terms of different potential outcomes for inflows rather than the exact reason for that outcome. So for example, another way to look at that dotted green line, the announced pledges scenario, is to say, what if inflows over the next decade end up being about half of what we're expecting right now? Whether it's production-based or price-based or some combination of the two, if the outlook for inflows changes in our forecast period and was to be lower, how would that affect our pacing models, our liquidity assumptions, et cetera? So to try to answer that question, we had our strategy team work together to run that lower inflow scenario through our fund growth models and our pacing models. And what we found is that the difference in level of annual commitments to private assets that are needed in that scenario versus our baseline assumption is about 500 million a year, but that's in the context of about 7 billion a year of planned annual commitments and that we need in order to get to our target allocations. So because we update these models very regularly to incorporate those actuals and changes, and then we reset our pacing plan accordingly, we believe that that difference could be absorbed through adjustments to future pacing should it turn out that over the next few years, we should be planning on a lower inflow estimate than what we're planning on now. So what that exercise does is really help give us more confidence, both in our current inflow assumptions in terms of, being pretty reasonable given the various uncertainties in the production outlook, but also more confidence that if that outlook changes, we should be able to pivot accordingly. And I am going to stop my comments there. I don't know if Vince or Steve or even Nino have anything that they want to add on that, but I am happy to stand for any questions from the committee.
Anything more from staff before we go to committee council questions? So I think it's worth noting, because you've included the IEA announced pledges and net zero predictions, that the head of the IEA actually has stated that he predicts we'll see peak oil before 2030 because of electrification. Yeah. So that's kind of what we're working on from here.
That's an excellent point, Madam Chair, and you'll notice that in the scenario when you look at those production, that the IEA's net zero scenario is much more accelerated than the others.
You think back to the trouble that we've had and several years ago, and where we are now, it's just unbelievable. When you think about, 2 or 3 years ago, we're talking about the severance tax fund disappearing. And these changes are pretty spectacular, so it's amazing to see this.
Any further questions from council members? So Don, I wanted to offer my gratitude for this analysis because I feel like, you know, it's got variables for sure, but it looks solid and conservative from my vantage point.
Thank you, Madam Chair.
The OPEC numbers are kind of nuts, though.
It's good that you point out, Madam Chair, the conservatism. We do actually make pretty significant attempts to bake in conservatism as much as we can into these estimates. We can always plan for more or adjust for more. It's harder to adjust for less. So in our baseline price assumptions and the way that we look at production scenarios, we do try to bake in conservatism into those. So despite the fact that these inflows are pretty high in terms of historical norms, we do think that our baseline assumptions are relatively conservative.
Further questions from council?
Madam Chair, John Bingaman.
Member Bingaman.
Yeah, I'd like to just also say I think it's an excellent analysis and really appreciate it. And I think the governor and the legislature deserve a lot of credit for hearing, I think, what the staff and others have been saying about the severance tax fund and making some of those changes to bolster the fund in recent years. And I was just going to ask Ms. Iglesias, could you, as you do this forecast out, and I think Vince had made reference to the $100 billion number, is there a way to just sort of forecast out, based on our current projected returns and some inflation assumptions and the current statutory distributions, what a snapshot of each of the funds would be at, 2030, 2040, and 2050 under these scenarios?
Absolutely, Member Bingaman. And just to clarify, are you looking at a snapshot in terms of the size of the fund or a snapshot in terms of the distributions from those funds?
I was thinking the size of the fund, and then anyone could just do the math to get to the distribution number, I think, but I think that'd be interesting to see.
Absolutely, we have that together. That's part of what Vince was referencing. We put that just like you said. We look at these inflows, basic assumptions in terms of returns and where we think the funds will be. So I'm happy to get with with Vince and see about getting that to you, Member Bingaman.
Thank you so much.
And I'm in agreement with your kudos to the legislature for their recent actions around the severance tax fund. Anything more on this item? All right, hearing none, we're going to move to agenda item 3C, and we'll have the presentation on the asset allocation studies, but we'll have to see from the appetite of the legislature, the appetite of the council about taking action today. So Vince, I don't know if you want me to turn it over to RVK or you have some introductory comments.
Just a few introductory comments, Madam Chair. Thank you very much. If you would return to page 54 of your book, it's part of the presentation that you just saw. And it's the chart there on the right-hand side. The hard numbers, I don't think we've gotten the report. We can get them to you, but I'm referencing the blue portion of the bars and the yellow portion of the bars. That's the projected inflows into the land grant fund and the severance tax fund. You're looking at something that is incredibly important and incredibly powerful. In fact, two of the most powerful words in finance our compound interest, or just compounding, as we talk about our investments in total, those inflows that we're projecting, when you calculate what the distributions will be for these funds, those inflows look like for the next 10 years will cover the distribution of from the funds. So in other words, the flows into the funds will be at or higher than the statutory distributions that we make from those funds. That opens an incredible 10-year period where we can compound the returns of these funds for a decade. That's incredibly powerful. Albert Einstein called compound interest the eighth wonder of the world, and we're going to get to employ the eighth wonder of the world in these portfolios for the next decade. It looks like to me. That's incredibly important. There looks like there will be no leakage whatsoever in the NAVs of the fund for distributions. That lets that money stay in there and compound its way to higher valuations over the next 10 years. And that really means something in terms of the asset allocation of these funds. And we're going to show you some changes that we think we should make to the asset allocations, based a lot on what you're seeing in that chart. So two things have happened, or two things are applicable. First, the liquidity needs of these funds have fallen by a lot. So we don't need to carry some of our lowest expected rate of return investments in some of these portfolios, because that liquidity will be coming from inflows. So our bond exposures, our cash exposures, any short-term type related investment that has a low expected rate of return but a high degree of liquidity and stability, we can start pushing that money out into longer-term, higher returning investments because of these inflows. That means we can push out the risk curve. We can take more equity risk. We can take more illiquidity risk to get money into higher returning things, to get higher rates of compounding. It will look like magic over the next few years in terms of the way these funds will grow, being able to compound those returns. So what you're going to see in these asset allocation studies, Madam Chair, are exactly that: an increased equity, decrease to some of our more stable investments that provide us income and liquidity. That looks to us like it's going to be replaced by these inflows, and it is much to the state's advantage to get that compounding engine cranked up, and we're going to show you asset allocations that will do that. Also embedded in our plans, or in our asset allocations, you'll see several things from the macro and market side. We'll be delivering the annual investment plan in June to you. Unfortunately, even though we have this awesome opportunity to compound returns in our portfolios, we're not going to have a very good environment to do it within. We're projecting a weak economy. We're starting with high price markets here at the beginning. We're expecting higher market volatility, although we can take advantage of that, and we'll talk about that a little bit. We're expecting we're going to suffer bouts of inflation as we go forward in the next 7 to 10 years, which is the length of time we look at with the annual investment plans. We think there'll be geopolitical problems. So I think we're facing food issues, we're facing energy issues, we're facing labor issues. Sorry to deliver the bad news, but I'll give you more of that in June. But we still have this great chance to compound returns, just not that great of environment to do it in. But we think we've got a plan to manage that. Let me give you some fund specifics information here before we get into it, to kind of give you a feel for where these asset allocations are going. The increased distribution from the land grant is very much an issue. We're in financial nosebleed territory, 6.1% effective. That's eventually going to make liquidity a meaningful consideration for land grant, but not in the next decade. We think those inflows will cover it. When we combine that ability to compound, we think it makes sense to cut our core bonds and and also to move money from the publicly traded areas to the private areas where compounding works at the most effectiveness. And you'll see those changes in the land grant. With the severance tax, I'll add to Member Bigeman's and the chair's compliments to the legislature. That fund was hurting, and the changes that they've made really give us a chance to grow that fund, compound those returns in that fund. And it needs less liquidity now with those changes and the greater inflows to that fund. The Early Childhood Education Fund, based on the inflow expectations, and those are in the light blue in your chart on page 54. You can see big inflow last year. Next few years, we're expecting some, but then it dries up to zero. This fund will wind up looking like the severance tax did, low growth, because the distribution will be, a large distribution relative to the investment earnings from that fund, but no inflows to help offset that. So the BCE will look a lot like the severance tax did yesteryear for that fund. Tobacco, there was legislation to take tobacco out of the reserve funds. That ultimately didn't get signed by the governor. So you'll see no change in the tobacco. We actually did an analysis of the tobacco with it taken out of reserve funds, and we could add substantial return to that portfolio, investing it more aggressively if we did not have to consider it a reserve fund. Water has got a great new injection from the legislature. They did a great favor to that fund. That fund we expected to go to zero over a very short period of time. That's got a much longer life, and you'll see the asset allocation on that fund. We've hit the accelerator on that one and try to make that fund last as long as we possibly can. The TSR, the Tax Stabilization Reserve, you won't see much of a change there. I think the council's sort of nailed the balance of liquidity and safety with some growth in that fund. So we're pretty happy with that asset allocation. You won't see much change there. One thought is we possibly could diversify the 48% allocation that we have to non-core fixed income and real estate with a third allocation to real assets. Just sort of take that same 48%, and you'll see it on the chart when we get there, and allocate that among three sectors, three economic sectors instead of just two. And last, the rural libraries, given its tiny size and reasonable distribution, which doesn't happen for a few years, we may have a little too much liquidity in that fund. I think we do have too much liquidity in that fund, and we've got the opportunity to pump up the return volume a bit on that fund. So overall, the ability for us to be able to compound these funds with inflows matching or being better than distribution is a 10-year period of time where I think we can really, really do a lot of good for all of these funds. So with that, I think we're starting on page 62. Matthias and RVK and I are going to tag team this a little bit as we walk through these funds, but I'll turn it over to Matthias to get started on that.
I think Marcia will give us a quick intro, and then we'll get working through. You see the seven funds that Vince just walked you through. We'll walk through those fund by fund, but make just a couple overarching comments first.
I'm going to take you to page 64. Thank you, Matthias and Vince. And set the stage for what we're doing today. And this is a chart that we love at RVK. Everybody's heard that before, but this is a page of institutional investment decision-making and what we believe to be, and studies have shown to be, of most important. And just say right now that the selection of your asset allocation is the largest driver of return. But before we get there, we do something. Well, you saw it today with Don and Nino's work, investment staff's work. We need to assess the health of each of the funds. And we do that by linking investment policy, your contribution sources, and distribution framework to understand how much risk and what return you need from each of those, or would like to have from each of those funds. And we do that through intergenerational equity, The work staff has done has been very additive to this process. And just to piggyback on what everybody has said, the changes that the legislature made to these funds have changed the story, changed the game. So we're starting from a new place. Add to that, capital market assumptions improved this year. Our long-term forward-looking expectations for return has improved somewhat. So that really drives the health of the plan. So we can look at risk return, and that has changed. So we take that information that we've learned to the left, from the left-hand side, and we focus on asset allocation. And that's where we model different portfolios. We'll go through those today to see, look with your new outlook, what is the most efficient portfolio given the expectations for those funds, and that drives what you put in each of the asset classes. So that's what we're going to be doing today. And I don't want to take away, and that is driven by staff and the strategists. I don't want to take away from the right-hand side of the chart. Your investment asset class directors need to work to then make those asset classes perform to meet the expectations of the asset allocation. So everything we try to summarize on this chart. So certainly the inputs or the changes made by the legislature has changed the game. I also mentioned that your CMAs, your capital market assumptions, has changed. We're not going to spend a lot of time on them, but if you go to 71, we'll show that the expectations or the outlook or the forecast for future return and standard deviation has provided a better looking picture. Certainly with the market going down, the valuations are still high, but better than they were. For fixed income, yield matters, and yields are higher now. And as Vince talked about, with inflation being high, but expectations for inflation are in line where we had them in the past, because these are long-term assumptions. So inflation stayed the same, but expectations for return for most of the asset classes has improved, and standard deviation has stayed virtually the same. So those, along with what the legislature gives, makes a new picture for you to look at asset allocation, and that's what we're going to do today.
And we have spent extensive time discussing these capital market assumptions with the investment committee, and have been vetted thoroughly with staff. So we have a reasonable amount of confidence in these numbers over the long term. And I think we are in a great situation where not only do we have the benefit of positive inflows that is really wind at our back, but also the capital markets, at least for the current period, being more cooperative on a go-forward basis, which makes return targets more attainable, as we'll look at in just a moment. So we'll start on page 73. We'll work through this fund by fund. There are 7. We'll spend a little bit more time on the first one just for orientation purposes, and then work through the differences and some of the proposed changes. Again, if the changes are clearly articulated and you feel comfortable, I think there's an opportunity to make a decision, but certainly not a requirement. We'll plan to bring it back next month if you so desire. In terms of nomenclature, you see there in blue font, LGPF, that's your current target allocation as adopted by this council and memorialized in the investment policy. The LGPF1, apologies for the lack of creativity, it's really just for brevity, it is the proposed target allocation. So it shows you essentially your current target allocation versus what you might consider adopting under that number 1 nomenclature. As I said, this is a tool that helps us weigh trade-offs essentially between both risk and return, but risk is difficult to find with a single measure. So we certainly try not to do just that. In all of these models, there's limitations. I think we're pretty humble in terms of recognizing those and try to supplement them with additional analysis. So whatever the model spits out isn't always necessarily going to be the final recommendation. For example, the model doesn't know that you will be having all these wonderful inflows that really offset your liquidity needs, your capacity to take risk, as well as your ability to ride out certain market swings over the next decade or so, when you have the benefit, and any other pension fund or other fund would love to be in the situation where the inflows essentially offset the outflows, because you don't have the need for any cash and can truly invest in the long term. So all these comments really just to set the stage in terms of what you will see in the types of changes going forward.
Hey, Matthias.
Yes.
Could I just ask a question before we get started? Do these allocation changes have to be done as a whole? Can they be done fund by fund, or are they designed
Fund
to
by
work
fund.
together?
Fund by fund.
So could we take action?
Yes, in terms of,
is my question.
Right. Yeah, they're independent of each other. So I would say that in terms of the decision, but then also the implementation likely will take different amounts of time based on the magnitude and the volume of changes for each of the funds. And your policy provides a fair amount of latitude to implement that in a thoughtful way, rather than being susceptible to perhaps making those changes in a way that wouldn't benefit the fund long term. So these are long-term strategic targets, but it may very well take some time getting there should you approve them.
Madam Chair? Can someone share the document on the system so other people can see it that are watching online?
So I think what all this amounts to is, at least for the time being, the luxury, if you will, of really seeking the best risk-adjusted returns without needing to worry too much about liquidity or other aspects. It's really a bit of investing nirvana, and will allow these funds to grow in a compound or exponential fashion for the next decade or so. And again, I think it's important to recognize that appears to be the case even with some conservative assumptions on the inflow. So it's not putting all your eggs in one basket and assuming that has to come true. I think you can have a range of outcomes for that still to work out. And that, of course, then means we can focus on getting a little bit higher growth and trying to grow these assets. The nice thing, and we've done lots of analysis on this subject, is by allowing these funds to grow, really your dollar distribution that is able to be generated from these higher assets is actually substantially higher for the long term. And that's something that is true into perpetuity versus just increasing the distribution rate today that continues to limit the size of the fund. So it will have long-term benefits that will continue to pay dividends. Madam Treasurer, can you see the presentation on your screen now? Okay, great.
I can, thank you.
I think we're getting close to full screen here.
Can you put it at the top?
We can see it perfect on our screen, or I can see it perfect on mine. Thank you.
Okay, perfect. So we're working off of page 74, which I think is projected. Here we see about 2/3 of it, but I think that's probably all right. Most of us have other means of viewing the data. And as Vince already alluded to, for land grant, it's largely pretty well allocated already, but there are some minor changes, really opportunities to take advantage of this lower liquidity demand for the foreseeable future. And some of you may recall that the allocation to U.S. aggregate fixed income, which is your traditional plain vanilla fixed income for the most part, was determined based on some analysis to say, okay, we have a pretty substantial drawdown or market correction defined around 30%. How much liquidity would we need in order to rebalance, to make distributions, to take advantage of that market dislocation and redeploy that capital? And that analysis came to about 10%. Again, with these inflows covering most of the distribution, that number could arguably be lower. And with some of the more recent drawdown scenarios, I think there was some test cases that 10% probably is more on the high side. So one of the big changes you're seeing here is further taking fixed income down from 10 to 6%, in line with Vince's comments, seeking higher returning assets in place of that, with those 4% being allocated equally to real return and private equity, both long-term diversifying assets with a high growth potential. The implication of that is at the very bottom, at least of our screen, in bold line, the expected compound return of 7.4. That's about 20 basis points or 0.2% higher than your current allocation. Once you get out on the more aggressive end of the efficient frontier, it's pretty difficult to pick up compound returns. So you're not going to see big changes like you would going from 4 to 5%. But you are picking up 20 basis points, which of course will compound, and that interest will get earned on prior year's interest and earnings along with the balance. So that's where some of that supercharging growth that Vince and others have talked about will be coming from. And also importantly is that year over year, Marcia said assumptions improved. You can see those in that bold bottom gray box with 2022 assumptions. Last year's geometric or compound return expectation was 6.1. So we picked up over 1% just in terms of what happened last year with essentially the market correction. So we're above the 7% return target that we currently have for land grant. That's a nice change, and making some incremental enhancements and refinements to land grant by picking up 20 more basis points. There is a modest decrease in liquidity. You can see that titled RBK liquidity metric. It's near the bottom there, from 58 to 56. So very modest, but as you would expect, and that's appropriate given that you have the ability to take on more illiquidity, and so that's exactly what you're doing. So in aggregate, we think that these are changes at the margin, but could be additive over the long term and are consistent with both the themes and the cash flow profile that we expect for this fund for the foreseeable future. So I'll pause here for question, comments, and anything that Vince would like to add.
Yeah, thanks, Matthias. Do you want to take the question first, Madam Chair, or hear a couple more comments?
Let's finish with, so Vince, make your comments and then we'll take questions on this fund.
Okay, great, thank you. So I think the change here in land grant has obviously been to reduce our fixed income exposure. Most of what's left there is for rebalancing purposes. So we do expect volatility in the publicly traded equity markets. That fixed income allocation is really there to help us rebalance if equity markets take a big drawdown and become underweight relative to our targets. We need a source of funds to be able to purchase stocks at those lower prices and get our weights back up. So primarily what's left there is for that purpose. We are going to come talk to you probably this fall about the potential to add a component to allow us to have some fund level leverage, so we could use the derivatives markets to rebalance. It would cause a little bit of leverage in the broad portfolio temporarily while we did the rebalancing, but we could offload most of the rest of that low return fixed income and move it to higher returning assets with some ability to lever. The choice of the two risk assets, really, we do expect here in the nearer term, the 7 to 10 year time frame we use to base these decisions on. We do expect a little bit higher inflation, and we expect it to be sort of episodic and come in bouts. So that real return portfolio is very protective of assets in an inflationary environment. We think that's one to boost up. And then the second is private equity. We really like this asset class, particularly over the next 10 years. It has probably the most compounding power of all of our asset classes. We review these asset allocations every 3 years, and so we targeted 15 here, up 2 percentage points from our current exposure, because that's about where we think we could get over the next 3 years. Much higher than that, we would really have to take some nearer term, risk in near term funds. So we think it's reasonable to get to 15% over the next 3 years, and then 3 years from now, we'll take a look at it and see if it makes sense to go higher. So I would say private equity is an asset class we're still very favorably oriented toward. Would like to see it higher in this asset mix, particularly the coming period of time that we have over the next 10 years, and expect that number likely would go up next time we review. Last comment, Madam Chair, is 7.9% arithmetic return. We're getting to old school territory here. Eights are what we like to see, and you'll see a couple other funds that do have an 8% expected return. But thank you for that time.
So I think I heard the treasurer has a question on this one.
I do, Madam Chair. Thank you. So on the bottom of that page, where it says 2022 assumptions, is that the current risk factor, or is that what you're wanting to move toward on each one of these?
That's a reference to what those expected return and risk numbers were this time last year. So where valuations and market expectations stood a year ago. So it's really just saying how much have things changed over the last year. And probably the best number to look at is that GEO return, which takes the arithmetic return and bakes in the risk. Then you can see that was 6.1 last year. So using the current allocation, that not making any changes, that same allocation now going forward is expected to return 7.2, that expected compound return in that bold line about two-thirds of the way down. So just if nothing else, that allocation has picked up 1.1% in expected compound return, just through the passage of time and what's happened in the capital markets.
So is there a way, if the council approves whichever one of these, for you to have the assumption of where you would be within 5 years, 10 years, especially since a lot of what I'm hearing is that you want to go more from public to private?
The column in green, that's your current allocation. So really the only option being proposed is in blue. And I think in line with Vince's comments, those allocations, those proposals like 15% to private equity, is what's considered reasonable to get to in over the next 2 or 3 years. So even if we wanted to have, let's say, 20% in private equity, we probably couldn't get there in any reasonable amount of time. So we're not proposing that or considering that. All of these percentages are pre-vetted as sufficiently reasonable to be able to get to over the next year, 2 or 3, depending on how markets develop.
There's a slot.
Yeah,
Sorry,
at least for this fund, because the early childhood, just looking ahead, is much more dramatic.
Mm-hmm. So, Madam Chair, the reason why I asked is I started looking at each one and trying to compare, to see what the differences were, how it was currently being done, or what the expectation is for the future. And I noticed that on this one, it had the highest risk. But there was a page right before it, page 70, I think, expected compound returns. Those 2 pages, RBK's capital market assumptions, year over year changes. I thought those 2 were really critical to the conversation. If If you could talk a little bit about those two, because I think those two help us on all of the funds as to what you came up with.
Yeah. So this is the same thing, showing the lighter colored bars are those expectations for asset classes a year ago versus now. And there's a couple, I think, major themes that you're seeing here. I think we're trying to right size their screen, but a couple comments that I would take away from this page is that last year, if you look, there was hardly any asset classes that were expected to return above or at your long-term return target of 7%, that orange dashed line. Really, it was just emerging markets and private equity scratching at that 7% return target. Now you have 6 or 7 asset classes that are at or above that threshold. So it's a lot more reasonable to anticipate 7% going forward. That's number one. The biggest year-over-year change, and probably not surprising, is on the fixed income side. That's on the very far right-hand side in green, the 6 or 7 bars on the very right-hand side. They almost doubled in some cases, and that's because we've had a historical increase in interest rates just over the course of the last year. And so on a relative basis, fixed income for most investors looks pretty attractive because it increased the most. However, all the things you need fixed income to do for the typical investor don't really ring as true for the SIC, given all the cash flow dynamics and other considerations that Dawn and Vince and we've been discussing. So even though fixed income looks more attractive, it doesn't really help in a meaningful way contribute to compound growth that far exceeds some of the longer term expectations. But it has become more attractive on a relative basis. So in terms of the allocation differences, there's a different starting point. They're not all starting from the same place. Early childhood, for example, is much smaller. Rural library, another example, much smaller. So the differences in terms of being able to get to a certain target, particularly in the private markets, doesn't hold as true for a $15 million fund as it does for one that's 30 billion, for example. So there's some differences, some qualitative differences that are being considered here as well. Early childhood, for example, and I think we'll get to most of that as we're working through the funds, has a statutory directive to be invested like land-grant. Well, it hasn't really looked like land-grant for a long time, and this is an effort to get in that direction, particularly as flows, at least for the short term, are more accommodative. So there's some changes being proposed here that factor in not just the capital market environment. The backdrop always is capital market environments, but it's looking at the inflows, which of course the model really doesn't have a look through to the level of detail that Dawn provided, and some of these other requirements of the fund, sizing, things of that nature. So it's really a collection of a number of both quantitative and qualitative considerations that are driving that proposed portfolio for each of the funds shown in that blue column.
Thank you. And Madam Chair, I heard a lot this morning so far that we have a lot of liquidity. Do we have a listing, or maybe for the next month's presentation, a listing of each of these and what's considered a lot of liquidity for each one of these funds, or how it's determined what that liquidity looks like and how much we want to change that liquidity need?
Treasurer Montoya, are you talking about the cash balances or the allocation to the liquid asset classes?
Madam Chair, I thought I heard that with each one of these and the structure and what we're trying to change, that we don't need as much liquidity anymore because of the inflow of funds coming in. So that's part of the determination of how we're going to change the asset allocation. Did I misunderstand that?
Oh, no, that's absolutely correct. I think the liquid asset classes are the three at the top of the chart that you see there. broad US, broad international equity, and then US ag fixed income. Those are the asset classes that have daily liquidity. The equity markets move around, so that liquidity is conditional. We hate to sell stocks when they're down 20 or 30%. So the liquidity of the equity portfolio is conditional. Liquidity of the fixed income portfolio is very high. It's heavily weighted to treasuries and high grade securities like that we can sell without a lot of volatility impact.
Well, and I would just add maybe one more in terms of liquidity. You have organic liquidity because you have inflows coming in and they're sufficient to satisfy the distribution formula. So, for example, if on average you have 7 or 8 or 9% in terms of inflows per year, and your formula for distributions is 5 or 6%, so below that inflow percentage, you're net cash flow positive. So even if you earned nothing, you essentially don't have to liquidate a penny in the portfolio because your inflows could come right back out if they needed to satisfy that. And that ability to hold assets, not need to sell any of the assets that you see here, is really the secret sauce here.
Thank you, Madam Chair. The last comment I would make, and this is also me needing a better understanding, and I don't know if this is everyone on the council, but if we're moving more from public to private with public funds, then I think there needs to be more of a standard evaluation for us to be able to make good decisions when we're talking about risk and what that level of risk looks like, as well as cost. And what that cost looks like, and if that risk factor and that cost are really showing a positive over if you didn't take as much risk or you didn't have as many fees. And so for me, I think that's one of the biggest issues I've heard in the last couple of years that I'm trying to be attentive to and better understand, because I haven't worked in private equities, but that's something I think that we should all factor in. Thank you, Madam Chair.
Anything further from the council on this proposed allocation change? Okay, I think let's move on to the next fund.
Okay, very good. The layout is the same for all the other funds, so hopefully things will make sense in terms of how they're laid out. Let's move to page 76. That's for severance tax. Again, we have the current and the proposed with the same nomenclature. Vince already provided some of the high level details in terms of severance tax a few years ago was in really rough shape, and now has similar to land grant a much better outlook and liquidity profile. Historically, there's been some differences in investment between land grant and severance, largely in terms of the exposure to fixed income, but then also how private equity is invested, with both a portion in the national and another portion in the in-state program. That in-state program has a substantially lower return expectation, just given the uncertainty around some of the investments. They could be high, they could be low, and so there's a conservative expectation for that. And one of the things that you're seeing here that we've tried to do, largely because again, the improved overall health of this fund going forward, or at least expected to be going forward, is an even closer alignment between severance and land grant than has been in the past. So really an opportunity to try and align those more. One of the key attributes as part of that is a tightening of the gap between the expected return between land grant and severance. It's down to 50 basis points from 70 basis points, and most of that is attributable to the in-state private equity program versus those dollars being invested in the private equity program. But again, the in-state program has a dual mandate. It's not just earning return, but also, of course, economic development and other purposes. So that's main difference. So in terms of asset classes, you'll see the same ones impacted. Fixed income, core fixed income, a decrease of 7 percentage points from 12 to 5, with an increase to real return and private equity. All the private equity is going to the national program, or at least it's earmarked to go to the national program. That, of course, is a higher risk-adjusted return. So overall, this is an allocation that does fit that criteria. Better alignment with land grant, improvement to the return differential. Overall, improves the expected return. You can see 6.7 for the proposed allocation compared to 6.4, which is your current allocation, picking up 35 basis points, rounded here to 0.4%, which is a meaningful increase in terms of return expectation. And similar trends in terms of, as a result, expecting a little bit lower liquidity. You can see it down at the bottom, 58 versus 54, and a bit higher equity beta, essentially sensitivity to the equity markets. All of that in line and by design with expectations where we think those dollars can be most additive, most effective, given the investment objectives, but also considerations. So I'll stop here. Again, questions, comments, or any additions Vince would like to make.
Yeah, thanks, Matthias. Just one. So as Matthias said, same pattern of cutting back on fixed income and reallocating that to higher returning assets. Again, we hit the real return area because of some inflation expectations. 5% is aggressive in terms of getting to that increase, to getting to 10% in severance tax over the next 3 years before we evaluated. Our pacing model says we can get there. We've got a great deal of confidence in that. And severance tax is roughly half the size of land grant. So the decreased size will make it a little easier for us to get there relative to putting a 5% increase on land grant. So we think we can make it there, but be aware that's an aggressive target to get that up by 5%.
Madam Chair?
Member Messina.
Yes, thank you. I'm sorry, but could you tell me, Vince or whoever, what does capital preservation mean?
Yeah, those 4 categories, starting with capital appreciation, capital preservation, alpha, and inflation, are thematic categories where we essentially take those asset classes at the top and categorize them by their primary objective. So equities, for example, or capital appreciation, that's your growth engine. Private equity would also fall into that category. And you see that bucket increasing from 59 to 65. So it's an increase of 6, right in line with where you would want to deploy those assets if you're desiring growth, propelling growth. Capital preservation, that's essentially your safety net. That would be your traditional fixed income, cash, things of that nature that when the market falls apart is going to hold your portfolio together. And then the 2 below that are diversification and your inflation hedges, essentially. So that's another way of thinking about the asset classes, not just sort of by their name, but by their investment objective.
Thank you. I guess that the reason that capital preservation is down then is, excuse me, because of the expected inflows. Huh?
The reason you see a decrease in the capital preservation is because we're reducing fixed income 7 percentage points, and that's how much capital preservation is decreasing commensurately by 7%.
Thank you.
Yeah, thanks for the question.
Madam Chair.
Is that Member Tejas? I can't see my full screen right now.
Oh, this is Kurt Sommer.
I'm sorry, Member Sommer.
I have a question, Madam Chair, for Vince or you, in terms of the timing of changing that from private equity 5 to 10. What's your timing on that?
kind of staff participation does it take? Going to your whole question of, we don't have enough people. I look at your budget and I see that you're going to put a stress on people to do it, because that takes a lot more energy and time to investigate. So what do you do with that?
Thanks
If
for
you
that
could add
question.
that discussion to every single recommendation
that's
you're
a
making,
big-
I think that's a great context for council to have.
Yeah, that's a great question, and Kurt. Thanks for bringing that up. So we have what we call our pacing model. It's a complex mathematical model that looks back in history about how cash flows work with these private investments. So when we make a commitment of, say, $100 million, that gets drawn down over about 3 years. Those investments mature over the next 6 or 7, and they return that capital plus the profits to us. So we model that out for hundreds and hundreds of funds to get an idea of how that cash flow works. Our pacing models are telling us so we can get to 5% in the severance tax. We have to make a certain number of investments. They have to be of a certain size, and they have to be spread out over that period in a certain way. But all that's taken into account by our pacing model. It says we can get there, but it is an aggressive target. In terms of the staffing comments, thank you for that. I am so fortunate. We are all so fortunate to have the staff that we do in the asset class director area. These folks work hard. We're under-resourced in terms of help for them and analysts and so forth. We have excellent consulting that's helpful, but we need staff resources to get this job done.
Madam Chair, I raise this in the context of looking at budgets, and we're looking at the budgets that's out there. You don't have a full staff. You're gonna talk about more. I look at consultants, and your budgets are under there too. So how do you? I mean, realistically, where's this coming from?
We hope we've got our fingers crossed for the ads that we have planned, and I was thankful for Member Prop's comments about, you know, let's see your plans so we can understand them. We'll absolutely work toward that, but we need to add staff. We need to reconsider compensation and the methods that we compensate by. There's a lot of work that we need to do, and we need to start doing it now to get there before these funds are $100 billion in 10 years.
Thank you, Madam Chair.
Further questions? Okay, I believe early childhood is next.
Thank you, Madam Chair. That takes us to page 79 in early childhood. I think I mentioned already that I think the overall arching statute does intend for early childhood to be invested similar, although I think the language is probably has some flexibility around that. But the intent and desire is to have that fund long-term be invested like land grant. Although Vince mentioned the cash flow dynamics are a bit different. You do have a period of time where perhaps they're more favorable, but long-term it may very well look like what severance tax looked like in prior years, which of course wasn't as optimistic as what we're seeing now. And so that the current allocation in green that you see here was an initial leg into this fund, recognizing that going from zero to land grant probably isn't terribly prudent in a single step. So what you see there is a reflection of the market environment at that time, trying to lean into income generating assets, limit some downside, and make sure that the allocation get invested. You've got a good foundation, and from there start considering additional moves towards land grant. The allocation that you see here in blue is another attempt at that, although recognizing that here probably more so than anywhere else, given the magnitude of the changes and moving into more broadly diversified assets, and here namely publicly traded equities, that could take some time to get there because you have to go about it pretty thoughtfully. You're probably not going to double those allocations from one day to the next. And commensurately fund the other ones down. So this will take some time if you were to move in this direction. We think long term it's aligned with the directive of the fund. This may be a good time to do it over the next few years, considering again some of the cash flow profiles that are being anticipated for this fund, and you do have the flexibility in policy to do it in a way that is thoughtful and prudent. So by and large, you see a closer alignment, a decrease of both fixed income and some of the private market asset classes, and an increase to more of the growth engine, primarily in the U.S. and international equity exposure. In terms of what does that do to compound returns, you can see you're picking up about 30 basis points or 0.3% at the bottom. That is an improvement, of course, but as I said before, it does become increasingly difficult to add additional return because once you start moving out on the efficient frontier, the allocation that you have had for this fund has been, as I said, highly efficient. It's been leaning into income generating asset classes. You can see the annual yield at the bottom, 4.8. That's pretty darn good. But long term, this kind of allocation that you have before you under ECE1 likely is one that's going to help you grow a bit more and provide a more diversified source of ability or ways to generate compound return.
So Madam Chair, just a couple comments on this. Brent, you want to scroll back to the top?
Sure.
So the big differences in the asset allocation here that you see, and I think someone, it may have been you, Madam Chair, mentioned at the onset that a couple of these funds have big allocation changes. This one, when we first received the ECE funds, the statute was it should be invested like land grant over the long run, and and that's always been our goal. But when we first received these funds, the stock market was at nosebleed levels. The valuations were obnoxious in 2021, and we just, from that perspective, from the investment team perspective, and our management group perspective, and the council's perspective, we just couldn't bring ourselves to put a bunch of money in the stock market when we first got these funds. Just handing the legislature with a big loss right off the bat was not on our agenda, so we didn't. And in 2022, this fund was down 1.9% for the calendar year. The land grant and our other growth funds were down 6.5% for 2022, roughly. And some of our peers were down 13 or 14% in 2022. So consider some of those peer fund returns of -13, -14. That could have been the ECE, but instead it was -1.9% for the year. So what we're doing here is starting to catch the ECE fund up a little bit. We do not anticipate moving all the way from 8.5 to 20 in the near term. We're still a little afraid of stocks here. But at the end of the day, that's where we need to get. That's where the other growth funds are. But we need some time here. We're just not prepared to load up on the stock market right now, and we're hoping that opportunity will come in the nearer term. You see a 13% allocation to fixed income. That's reflective of our forecasts that inflows for this fund will dry up here in the next 2 or 3 years, and it'll be look a lot more like a severance tax. We've got a decade's worth of experience, more than that, in managing the severance tax, so we think that's about the right number based on how severance tax acted in the past with no inflows. And then the other minus signs there, pulling out of some of the private assets is counter to what we've been doing. That's moving from public to private. Is just simply to get more money into the stock market at the end of the day. So the 10% private equity is roughly consistent with the other funds. I think we could probably go up there a little bit in the future. And the real estate number is below where we are with the other funds. That number probably could come up a little bit more in the future. But you know, we need to wait on these. We need to wait on these, a better entry point into the equity markets. So that's why you see the big changes, but don't expect that big near-term changes to these funds or to that fund.
So are you then able to give us a better timeline around when we would get to that full allocation? Like, will it be phased in? Because this looks fantastic to me.
Yeah, absolutely a phase in, and the markets really will determine that. So, you know, if we were to wake up tomorrow and equity markets were 50% lower, I'd tell you, let's hit the gas and go right now, but that's unlikely. You know, we are expecting recession later this year. We are expecting stock markets to come down in response to that. So I think our first move would be later this year toward those 20% targets. Whether we go all the way, it'll just depend on how far down these markets go, how confident we are, you know, in their valuation at the time we make the move.
Because I'm not only do I not want to deliver a big loss, I'm just real cautious about this particular fund because of its purpose and my support of its purpose. And I think I understand the underlying reasons why we're trying to make this move, but it seems large in that's my own estimation of it.
No, we appreciate that conservatism in the allocation. You know, we are constrained a little by the statute that says it will be invested like the land grant. So we do need to show an expected return and expected risk level similar to land grants over the longer run. But we feel like we have enough flexibility given our market our market outlook to get there slowly.
So just to be clear, just because we're putting in that 20, sorry, does not mean
right.
that.
Right. So when we come back next month, we're going to recommend interim allocation targets. I think the interim allocation target for ECE is going to look a lot like the current allocation, the 8.5 and 24 and so forth. We may bump them up a little, but from now until we can get fully there, we'll have a series of interim targets, and I don't think this one's going to change very much. That's something we're talking about now with RBK and my strategy group.
Interim targets sound good to me.
Madam Chair, I have a question.
Madam Chair.
Now that you said that it's supposed to be similar to the land grant on the ECE, the green, when I look at land grant and ECE, they weren't equivalent before this. Is that something that just happened now during this legislative session?
No, that was in the legislation. It was just the judgment of the office and of the council. The council voted for that the allocation that you see in the green, the 8.5 for equities. It was in the office's judgment and the council's judgment that putting a lot of money in the stock market back in 2020 and 2021 wasn't the best idea given the valuations, and we were concerned about handing a big loss to the legislature, so we didn't do it. And as I gave you at the top of the comments, we lost less than 2% in this fund, while our peers lost 13% in their funds. So we avoided that big loss that we were concerned about. So now we think we need to show an allocation that looks like land grants or is like land grants. It's consistent with the statute, but we do think we've got a runway to get there, and we'll use interim targets to do that.
Okay, Madam Chair, Mr. Vince, I at first thought it was really shocking, but then when I looked at the similarities between all of them, it just seemed like you were trying to align more, and the top portions are a lot more of your safety net, correct? Your US.
That's the liquid.
Mm-hmm.
That's That's a liquid portion of the portfolio. So the equity we wouldn't call a safety net. It bounces around a lot. And it has some volatility risk to it. But absolutely, the fixed income is the safety net for this portfolio.
Okay, thank you, Mr. Chairman. Thank you, Madam Chair.
Madam Chair?
Member Messina.
Yes, I'm sorry, but I'm going to have to excuse myself now.
Thank you. Any further council questions on this fund? Okay, I believe we have tobacco next.
Thank you, Madam Chair. Tobacco on page 82. This is a fund that remains in the reserve fund status, and so we actually don't have a proposed allocation. I think we're collectively pretty comfortable with how it's allocated. It's reasonably conservative and strikes a good balance between growth and income. It's been performing quite well through this environment, and we think again it has a modest allocation to some of the growth, the liquid growth parts of the market, U.S. equity, international equity, and a sizable allocation to some of the other asset classes with a good focus on income generation as well. One thing I think you'll notice is it doesn't hold any private equity. So I think that's, as you look across the funds, that's probably one difference that might stick out to you. But overall, it's an allocation that we think is pretty well designed for the overall purpose of this fund, and for the overall market environment that we're currently in. If it were to come out of reserve status, then perhaps we could look at some alternatives, but it is still classified as such. I think collectively there was a good deal of comfort with its current allocation.
Yeah, Madam Chair, this fund, boy, would I like to put 25% in private equity. But this fund is last money out. So this is the last fund in the reserve that the legislature will tap. So we feel comfortable with a little bit of risk assets in there. So you see 45% between real estate, real return, the risk assets. Or I'm sorry, between fixed and real return. Those are risk assets. Another 20% real estate, and then 10s in the so we're comfortable having some risk in there because it's last money for the legislature, and we can get out of those things. The risk we stand here is if the legislature actually has to dip into that money, during a down portion of the market, we could have, these shorter term losses that we'd have to deal with. But as Matias said, if we can get this out of reserve status, if TSR can be the standing reserve fund that we manage, certainly another 5 or 10 percentage points in each of the publicly traded equities, and between 15 and 25 in private equity, because this fund doesn't have any outflows. It's effectively in the same shape as land and severance are now. The inflows offset the outflows. This fund is in that same position that we can really compound the returns, but we're just scared off a little bit by the reserve status of it, reasonably, in case we have to deliver that money.
So that's what Matias meant by reserve status. It's the last tapped in the flow, in the buckets.
It's in the reserve status, or it's in reserve, same as the TSR is, but it's prioritized last. It's last money
For the legislature to tap.
That's right.
Okay, yeah. I remember learning about that. Further questions on tobacco? Hearing none, let's go to water.
Thank you, Madam Chair. Page 85 takes us to the Water Trust Permanent Fund, and as we described, this was a fund that even just a year or two ago was on a terminal path. Essentially, it was a smaller fund, somewhere around $40 million with a 4% annual distribution. Yeah, right, $4 million annual distribution, which equates to 10-11% by the time you factor it all in. So very, very unsustainable. Certainly can't earn that reliably, and really no inflows. The $100 million cash injection from the legislature sure changed that in a meaningful way, and certainly extended the runway, maybe even indefinitely, short of a change to the distribution rate. But under the current framework, certainly has changed the dynamics of this fund in a very meaningful way. And so liquidity shouldn't be an issue the way it has been in the past. When you're needing to sell off essentially or liquidate 10% of the portfolio, that really hamstrings your ability to seek the best risk-adjusted returns. Now that it's a substantially smaller percentage, one that's very, very reasonably attained, with the additional $100 million or so, you really do have quite a bit more flexibility, small in size. So that also provides a bit of additional flexibility, that it's not such a large fund that would really swing the entire total asset base. So this does provide an opportunity to broaden diversification, and I think you see that here between the current allocation and the proposed in blue. A lot of the same trends that we have been looking at for funds that have been allocated in this way. Some incremental additions to publicly traded equity, both on the U.S. and non-U.S. side. A little bit more private equity here, and a decrease in traditional fixed income, real return, and real estate. So you see incremental enhancement to compound return, 7.5 currently to 7.6. But again, you've got a higher growth engine essentially, and higher ability to try and add some additional compound return to this portfolio over the long term, in light of the better cash flow dynamics that would be expected out of this fund going forward.
So with this fund, Madam Chair, we are relieved and happy to show an 8% expected rate of return. I've been allocating assets at funds like this for 20 years. I've probably done 100 of these studies, and I'm used to working with 8s and 9s. In the last few years, it's been 6s and 7s. So we are very glad to be back at 8%. 8% makes a lot of problems just not problems anymore. So we're really glad to get there. The high degree of private equity in this portfolio is our highest of all of our portfolios, 25%. This fund is so small that all of our investments are unitized, and so when we rebalance among the funds, we tend to just trade units. We're not actually trading in the markets, but we're trading units of the pools that the actual investments sit in. So if it comes to a situation where the water fund needs liquidity, we can sell units to the other funds, because this fund is so small. It's a rounding error for land grant to get water out of 5 percentage points of its private equity. So with sort of the natural liquidity we have, because we're unitized, we can take a little more illiquidity risk with this fund, just mainly due to its size. So we've really put this in growth mode. We're so pleased the legislature has fixed the short-term problem that water had, and we really want to grow these assets to make this fund as viable as long as it possibly can be.
Madam Chair, for clarification, how much is in this fund?
We're looking right now.
40 currently, and 100 incoming with the new fiscal year.
40 million? Billion?
Million.
Oh, okay, thank you.
Further questions on water?
Madam Chair, I did notice this is the highest risk one, and private equity is the highest in this fund other than the other ones, but I also see it only has 40 million. Thank you.
Yeah, exactly right. Some of those considerations that are less apparent do flow through into the allocations, as Vince mentioned. A 25% allocation in water is not really problematic. A 25% allocation in land grant would be very much problematic. So that's why there are some differences there. Right sizing it for the fund size and fund dynamic is another consideration that just looking at these numbers in a vacuum wouldn't necessarily tell you the whole story. We're coming around the final bend here, I promise.
Credit where credit's due to water. Senator Worth and Cervantes have been trying to get additional inflows for a long time, so. Just giving credit where credit's due. All right, TSR.
Very good. TSR, this is the primary reserve fund, and as such should be allocated in a substantially more conservative way. I think currently it does strike a good balance between liquidity, safety, and growth, trying to be mindful of the current market environment. You see here an asset class that is used sparingly throughout the funds, but makes sense here. Low duration fixed income, so that is your traditional fixed income, but with less interest rate risk, to make sure that those assets don't get impacted by rising rates the way that the broader fixed income market does. And last year, I think, was a good example of why that's a prudent way to think about matching the term of the fixed income with the potential liquidity needs of a certain fund. Bond yield over the last year obviously have increased in a meaningful way, and have closed the gap, the income differential between fixed income yields and real estate or cap rates. And so as part of that, the need to lean heavily into real estate isn't as great as it has been in the past in order to generate the same level of income or cash yields. And so one of the things that you're seeing here is a bit of a reduction.
Did we lose that audio for anyone else?
Yes, I can't hear anything either.
Sorry, guys, we can't hear you.
I don't think they heard us.
We lost the audio in the conference room.
I think we can hear you now. Can somebody speak in there? Nope.
I think they're still out. I'm hearing a phone line.
Can you hear us again?
When?
Yeah, from a
Hello?
phone line.
Disappeared.
Can you hear us?
Yeah.
Yes, ma'am.
Okay. Yeah, the audio is coming from a phone line.
Madam Chair, we were right, just giving some color on this particular portfolio. I was saying that given information we've been able to develop, we think it would have to be dire straits in terms of the state budget for the legislature to want to take more than half of this fund in a given year. So you can see from the allocation, the new allocation, we've got a little bit more than 50% of the assets in our most stable asset classes. These are asset classes that we could take to zero, or at least sell all of the assets with minimal capital loss. And then the other 45% we've got allocated to some asset classes where we can expect a little bit of growth, some credit risk in the non-core fixed and some inflation protection and risk with the real estate.
Questions on the tax stabilization reserve fund? All right, and we skip rural libraries. Do we do that one?
That's the last one.
That's the last one. Great. Let's do it.
Okay, very, very good. Rural library, this is the last fund, and it's quite small in size. And overall, I think what you'll see here is it's really the only other fund that also employs low duration fixed income. There's been, I think, a recognition that this fund probably has too much liquidity as part of its current allocation, with no exposure to publicly traded equities and about 30% targeted to low duration and another 22% to U.S. aggregate core fixed income. So this is a relatively conservative portfolio allocation. You see no exposure to private equity either there at the bottom, 0%. Portfolio allocation that, again, it is newer, and I think there's probably some desire to make sure that the timing of funding this allocation when valuations were in nosebleed territory don't necessarily provide a bad experience right off the bat. Here, similar to some of the other funds that we've looked at, there is an opportunity to take a little bit of the liquidity out of the portfolio that's arguably excess liquidity, redeploy that into longer term growth assets, both in the publicly traded side, also private equity. Again, you see a big number, 25, but it is a very small fund that again is what offsets some of that change. And a decrease in some of the capital preservation assets, primarily low duration and core fixed income. So it's very much in line with a lot of the themes and trends that you've seen. terms of the resulting change to the risk return profile, obviously a big change results in a big increase or improvement in expected compound return from 5.2 to 7.6. This is another fund that, given its ability to lean into some of the higher returning asset classes a bit more, is showing an 8% arithmetic return. So that's nice. That's nice to see. And while the risk does increase, you are getting compensated for that additional risk. I would expect that getting to this allocation is going to take some time with perhaps some interim targets along the way. Obviously, there's a lot of changes in terms of the allocations, even though they are unitized and you could make them quickly, you may not want to, but certainly Vince will keep you apprised of that. So I'll stop here, but again, happy to take any questions or comments after Vince's remarks.
Yeah, just very briefly, Madam Chair, on this allocation, we've, as pointed out, we've really, pushed the allocation to the private areas and to get more return. That 7% that we have in the ag fixed income, that's still a point of debate among the strategy group at RVK as to whether we need that allocation. This fund is so small that unit transfers or unit exchanges with the larger funds could easily meet the liquidity needs of this fund. So potentially that 7% that we have in fixed income could be rolled into non-core fixed or even to boost the other private asset classes. We just don't need the liquidity and just don't need the drag on performance. The initial allocation really was there because the original fund size was pretty small, and boy, handing the legislature a big loss with this fund just didn't make any sense to us, nor the council who voted for the allocation based on our explanations. But we feel like we can diversify it out. The distribution's reasonable, and we think we'll be able to generate enough cash. Certainly, we can do unit transfers to get even more liquidity if we need it.
Madam Chair, how much is in this fund?
$13 million or thereabouts.
And
$15 million has been appropriated, Madam Treasurer. So we'll get that in July.
And how much of this fund goes out every year?
Not more than 5%. It's got an unusual distribution model. And so it can't be more than 5%. Some years, if it's a bad year for investments, that number will be very minimal, de minimis. 2028, that changes over, and it'll start being more traditional with a 5% distribution rate.
It's about $650,000 a year. Madam Chair, the only reason why I asked is because libraries has always been an issue at the county level, city level, and state level. And the change in this structure is very dramatic. I understand it's a low amount, but it's just a little alarming when you look at it. But I understand your concept. Thank you.
I think, Treasurer Montoya, you made a very good point. I think the idea with this fund is best encapsulated on the expected arithmetic return line. So look at the expected arithmetic return for the current allocation, 5.4%. Yeah, okay, yeah, 5.4%. Look right next to it at the proposed expected return of the new allocation. It's 8%. We really want to grow these funds to help solve the problem that you just identified.
Madam Chair, thank you. I did see that, and it sounds so appealing, but it's also one of these ones that's concerning because it's libraries and it's the use of those funds right away. But if you're only taking 5% out each year, I think that makes me feel a lot more comfortable than I did when I first saw this. So thank you very much.
Further questions on this one? What is the will of the council in terms of taking a vote today?
Madam Chair, what I'd like to do is, the investment committee was very comfortable after we got the pleasure of hearing this for the second time today. And I was very comfortable recommending that we approve this as soon as the council feels comfortable with it. And I think that my recommendation would be, unless, I'm not sure what another month is going to add to what we've got so far. And my recommendation would be that we go ahead and approve it today. But that's my opinion.
Anyone else?
Madam Chair, for structural purposes, when we approve something like this, how often do we reevaluate what we've done to make sure that it's in line with market inflation and all the other factors that need to be evaluated?
Treasurer Montoya, we do these asset studies, asset allocation studies every 3 years, so 36 months. That gives enough time generally for us to get to the new allocations, and it has enough time that often RBK's forward-looking assumptions have changed, and our outlook for the markets and economy have generally changed over a 3-year period. So that tends to be the time frame that works best.
Madam Chair, I'm gonna, if it's all right, I'm gonna put this motion on the floor.
Madam Chair and member, if you could just give me 1 second. If we are going to put this on the floor for a vote today, I would ask that the childhood education and the libraries be removed from it. Because I'd like to do a little bit more analysis on those two and meet with Mr. Vince or Mr. Moise, if that's okay with the council.
Is that possible?
Or we can vote on every single one of them and I'll just vote no on those two. It doesn't matter. But if we're going to do that today, then I would like to make sure either do them separately or you can do those two next month.
I think maybe one suggestion would be it's gonna take a fair amount of time, but that's okay. We could vote on each one of these individually if we needed to, and go through them all. Or, Madam Chair, I'm not exactly sure what the proper way to do this is. This wasn't anticipated.
Madam Chair, it wasn't actually anticipated for us to vote on this today to begin with, but are there other council members that have any concerns on any one of the funds, or am I the only one?
I'm not aware that anyone else has any concerns.
I would prefer to vote on them separately.
And Madam Chair, Mr. Moise, Chairman Lavender, it's not that I want to vote against those two, it's that I want to get more information and look at some things because it deals with early childhood and that bill just came through. And some of my staff have told me that they'd like to talk to me about it. So that's why I'm saying I don't want to vote against it. I just want to be able to have an opportunity for a little bit more information on those two.
Can we ask if we can pull the rural libraries and early childhood out?
Madam Chair, I mean, as a chairman of the investment committee, I'm fine with that. That's okay. Let's take those two out. Let's vote on the package, and we can hopefully the treasurer's questions will be answered prior to the next meeting, so that it'll just take a couple of minutes, unless there's an issue that appears next time, that we can simply approve the next two very simply. Is that acceptable?
That sounds good.
So let's see, which ones am I taking out? Give me the abbreviations.
ECE?
ECF and the RLEF. Based on the recommendation of the Council Investment Committee, Consultant RVK and SIC staff, I move that the State Investment Council approve asset allocation for the land grant permanent fund, the severance tax permanent fund, the tobacco settlement permanent fund, the water trust fund, tax stabilization reserve set forth in the meetings and materials and is discussed by the council today.
Second.
All right, so we've got a proper motion by member Lavender. I believe the second was by member Summer.
Correct.
We could have a roll call vote on the motion.
Commissioner Garcia Richard,
Yes.
Treasurer Montoya,
Yes.
Secretary Props,
Yes.
Mr. Lavender,
Yes.
Mr. Summer,
Yes.
Mr. Tejas,
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-0.
Very good. Thank you so much for the presentation. We're going to move to agenda item 3D, black dot chart.
While we get Mikhail in and ready, let me make just a couple of comments, Madam Chair. So this is an analysis we've been doing for quite some time, and I think it closes a loop for the council. So you've just voted for new asset allocations for these funds, but what does that make our funds look like relative to our peers who face a lot of the same factors and decisions? Now, as we've talked, they're not as fortunate as us to have the inflows that we expect, but public funds at large have a lot of the same constraints and a lot of the same structure that we do. So how does this change? How does this allocations look like relative to the ones that they've chosen in terms of the expected returns and expected risk? And that's what the black dot analysis is to analyze. And we apologize for our lack of creativity in the name. If somebody can name this better, please call me and tell me. I will take you out for a hamburger or whatever you'd like, if we can come up with a better name.
Thank you, Vince. Thank you, Madam Chair. So the black dot chart, as Vince has mentioned, we've been doing that data collection exercise for quite some time now. Usually the things that we look at include, but are not limited to, target and policy asset allocation, fund assets, funded ratio, target return, discount rates, and etc. So all the data is collected from the cumulative annual financial reports. The data that you will see in this chart is from the 2022 annual financial reports of the peer group. Speaking about the peer group, there are a couple of changes that we made to this analysis this year. Number one is we added severance tax and early childhood education funds to the analysis. In the past, we only took into account the land grant permanent fund. Beginning this year, we decided to take a look at 2 additional permanent funds. And change number 2, our lineup usually consisted of 35 peers. This year, we expanded it by 1 fund, which is the Texas Permanent School Fund, the second largest sovereign wealth fund in the United States, second only to Alaska Permanent Fund Corporation, which is also included in this analysis. So without further ado, let's take a look at the next couple of pages, and I'm referring to pages 114 and 115 on your diligent book. Just a quick reminder, so those present the arithmetic and geometric returns. Those are in the absence of volatility. Those numbers would have been the same. If the volatility is present, there is a discrepancy between those returns, and the higher the volatility, the higher the discrepancy is. So I would like to take a look at page 115. Let's concentrate on geometric return analysis. Quickly speaking about this chart, so fairly simple, y-axis geometric return, x-axis is the risk calculated as annual standard deviation. Then you see 3 diamond shapes, colored diamond shapes. Those are the permanent funds. The yellow square is the hypothetical 70-30 public equity, public fixed income portfolio. And then the orange line is a trend line with an orange circle in the beginning that represents the average risk, average return portfolio. So taking a look at that, there are two ways you can look at that, vertical and horizontal. I prefer to look at it from the vertical perspective. So we are talking about maximizing return for the given amount of risk, while horizontal would be minimizing level of risk for a given return. You can see that early childhood and land grant are as close to the efficient frontier as possible, which represents a very good positioning from risk-return perspective. Severance tax, permanent fund is a little bit lower, so you can see quite a few black dots on top of it. So this performance has been dragged down by a couple of different issues. Number one is the asset allocation. That's a little bit more defensive portfolio, so there is a larger allocation to more defensive asset classes such as core fixed income, so that has dragged the performance down. And the second point that dragged it down was the fact that this is the fund that houses the New Mexico private equity program. So the combination of those two factors has resulted in severance tax be where it is. You've just heard Vince and Matthias talking about the asset allocation for severance tax, and one of the proposals was to move 7% from core fixed income and reallocate that to higher risk and higher yielding asset classes such as real estate and private equity. So I would assume that next year you can see that blue diamond shape moving a little bit to the northeast and represent a little bit more efficiently allocated portfolio from that perspective. The next 3 or 4 pages just dive into the individual asset class allocations, public equity, public fixed income, and alternatives as we stack up against 36 peers. Having said that, I'll pass it on to Matthias and RBK to add some comments, and then we will be open to questions.
Okay, thank you, Madam Chair and Mihail, for the comments. Just to put in a little bit into context, we've obviously been looking at your absolute exposures, but how do those compare to your peer group of other large funds with a similar opportunity set, a similar set of resources, as well as similar staff expertise, although I would argue that as we've talked about, you probably are doing a lot more with less. But we're trying to right-size this peer group to be as applicable as possible for funds with similar opportunities, but also similar investment objectives. I think it won't be terribly surprising as you're looking at this, and this first page here on 116 is kind of the overarching categorization of how you look compared to the peer group. The floating bars, so the range of different gray bars, is essentially the range across the peers. The first one is total risk assets. You can see a minimum of 68%, a maximum of 93%, with a median of 79.5%. So you can see there's a range of risk asset exposures across these funds, but for the most part, all of these funds utilize risk assets quite extensively because everyone is needing to earn a certain level of return over the long term, whether that's used for a discount rate or assumed rate of return for pension plans, return targets for sovereign wealth funds. Everybody is trying to earn as high a return as possible. The question is, how can you get there, and how can you do that in a risk-adjusted and risk-controlled way? You'll notice land grant, severance tax, and early childhood at the bottom. Those are the percentages relative to the median. That would probably be a good comparison, or certainly one I look at. And I think you'll notice that land grant, for example, currently has 10.5% more exposure to risk assets than the median plan. Again, you have the good fortune of substantial inflows. Many other plans or funds are actually net cash flow net negative in terms of their cash flows. So they're paying out more than they're taking in, and that limits your ability to take on risk assets. Being cash flow neutral or cash flow positive is a tremendous asset. It really allows you to pull in more of these risk assets, extend your holding period, and be able to benefit by having higher risk-adjusted returns. As Mahal showed you, you plot very favorably amongst that cluster of black dots. The public equity exposure is about in line, although on a percentage basis is a little bit lower, 40 versus 44. So you have to use publicly traded equities to some degree, but you're relying on those less than perhaps others in terms of your overall percentage of risk assets. You do lean more into the less liquid, the private markets. You can see 38.5 for the median versus your 50. That may very well increase, but it's appropriate again with the cash flow dynamics that we're talking about, and probably doesn't come as a surprise that as part of that you're utilizing traditional assets to a lesser degree, because again your overall characteristics allow you to do just that. The next couple pages break that down by equities and fixed income. Maybe just in the interest of time, I'll turn you to page 118. That's for fixed income. The high level on equity is essentially that you have less of a home bias than many other funds that tend to invest primarily or predominantly in U.S.-based stocks and equities. You are a bit more valuation aware, more agnostic regionally, and have a more diversified approach to your overall U.S. non-U.S. equity split. I think here, interestingly, and again, this all, if you're hearing consistent themes, that's by design. This story all should fit together. When you're looking at your fixed income exposure, you have less in core fixed income because, again, you don't need that liquidity. You don't need that safety net. You have a built-in natural safety net with strong inflows. So you have less exposure to core fixed income. That's your traditional fixed income, 10% versus 20 for the median, and that's going to be a byproduct for many of these plans of their payout ratio. So what percentage are they needing to pay out every year? Your percentage is essentially nil, or will be going forward, which is a very good thing. And instead, you're able to take on a little bit more credit risk and lean into the non-core fixed income, which of course has a high yield and better risk-adjusted return profile. So you see 10% less in core, 10% more in non-core, which if others had that option, I'm sure others would love to have your asset allocation. So there's a few other slides along with a conclusion. I would just say that you're very well positioned. You're about as optimal as you can be given the overall constraints that still remain in place. And I think the allocation that you have had has served you well when you look at your returns, but also the allocation that you're moving to should continue to serve you well for the foreseeable future. So I'll pause here.
Questions from council? That was a perfectly timed presentation after our asset allocation discussion. All right, hearing none, we're thank staff for putting that together. We're going on to agenda item 3E, which is the first of 4 investment recommendations we're going to be voting on. I'll turn it over to Mr. Cassidy for the National Private Equity Investment Recommendation into TCG Crossover Fund.
Madam Chair, Miguel is the 3H. I know you're normally supposed to do this at the beginning when you approve the agenda, but Miguel has the 3H presentation, and at the investment committee meeting, we actually had him present that at this point so that he can go back and get to work in his office. If that's acceptable, I'd like to ask that we cover 3H, if that's okay with you, very quickly.
Are there any objections to that from council? All right, Michal?
Yeah, thank you very much, Madam Chair. Thank you, Harold. So we would like to recommend the 3-year subscription to Strategas Macro Investment Research. To answer Treasurer Montoya's question, we've had them for a couple of years now in a trial period. We've been paying $85,000 a year. The current proposal is for an annual payment of $100,000 fixed for the next 3 years. We use that research quite extensively, so they cover 4 broad topics for us, including investment strategy, macroeconomic research, technical analysis, and policy. We have access to the analysts and chief economists. We are on the call with them on a quarterly basis. Also, we attend the annual investment conferences once a year and use just a broad range of resources that they provide. And the last thing that I would like to say is that they complement the current lineup of the resources that we have. So the other 2 macro research providers are Oxford Economics, which covers macroeconomics on a more global scale. So they have extensive coverage of Asia and Europe as well as the United States. And also we have Hedgeye platform, which is a little bit more quantitative and bottom-up, has a bottom-up approach. So this guy's output is being used extensively by us in a variety of different projects. You will see bits and pieces of it in the annual investment plan. Also, we take those themes and topics into consideration when we work on asset allocation and asset structure studies. Having said that, I would like to see if you have any questions, and if not, would like to recommend the $100,000 per year commitment to the Strategas investment research.
We are on page 310. Questions from council?
Madam Chair, based on the fact that these tools are so critically important for what we do, the investment committee unanimously recommended approval of this, of 3H.
Great, thank you so much.
Madam Chair, do we have any other contracts similar to this one? I think we do.
Yeah, so Oxford Economics, we have, I think, a 2-year commitment with those guys. And Hedgeye, we just started with them last year, so we are in the 1-year trial period. But all things indicate that we will extend those relationships as well. So yes, we have 2 other contracts similar to this one.
Okay. Thank you, Madam Chair.
Anything further?
Madam Chair, based on the recommendation of the Council Investment Committee, Consultant RVK, and SIC staff, I move that the SIC Investment Council approve a 3-year contract renewal for Strategas Investment Research under terms memorialized and discussed by the Council today, subject to and contingent upon the Mexico legal requirements and Mexico State Investment Council policies and completion of appropriate paperwork.
We have a second.
Second.
Okay, we've got a motion by member Lavender, second by member Summer. Take a roll call vote on that motion, please.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Prop.
Yes.
Mr. Lavender.
Yes.
Mr. Summer.
Yes.
Mr. Tejas.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-0.
Great, thank you so much. We're now going to go back up to agenda item 3E, TCG crossover fund 2, Mr. Cassidy.
I'll be as brief as I can be. We're recommending a commitment of up to $50 million to TCG crossover's second biotech fund. To give you some context, this is a later stage strategy. You compare it to Cure Ventures, which we brought late last year, which is really early stage on the company creation side. TCG crossover is a partner to the Column Group, which is one of the premier early stage biotech funds. The thing that makes the biotech unique is, unlike in the traditional market where the IPO is often considered the destination, in the biotech world, it's just a financing event. So TCG crossover invests in both public and private companies. When we say crossover fund, what we mean is, there's late stage or crossover rounds with private companies, and these are generally companies that are pre-IPO or close to a sale. And the fund will also do what they call structured transaction companies, that need to raise capital in order to achieve their, go through the clinical process and get to a drug approval or to sell the company. You know, over time, they expect to be roughly 50-50 split between public and privates. Right now, you know, for all intents and purposes, there's a lot of opportunity on the public side, which Chen Yu from TCG Crossover will talk about. But, you know, when we talk about public investments, at the end of the day, these are very similar to private transactions. They're signing confidentiality agreements with the company. They're looking at confidential data. They're negotiating discounts, royalties, warranties, warrants, basically the same thing they would do if it was a private company. So lots of public companies and private companies in the biotech space will need to raise capital the next year or two. There's really a dearth of capital to invest in the space, and so it's a good time, frankly, for this strategy. And you know, frankly, these are investments that are helping, you know, push clinical trials to their endpoint, so that, you know, these are therapeutics that can be used that are beneficial to society ultimately. I'll pass it along to Richard.
Thanks, Chris. In the national program, this fund fits into the venture capital category. It's a good complement to the current portfolio as it's focused on life sciences, and we don't really have a lot of life science funds in there. Most of the venture capital funds that you've seen us bring recently are more focused on information technology. The life science is actually a pretty sizable part of the venture capital industry. And it is more late stage than what you saw with the other life science fund that we brought later in the latter part of last year. We like that TCG Crossover is led by an experienced team. They're based in Palo Alto in New York. Managing partner Chen Yu was, before he founded the TCG Crossover, was a former managing partner at Vivo Capital, which implemented a similar strategy. And he has over 2 years of experience investing and working with life science companies. And there's 2 partners who joined Dr. Yu as members of the investment committee, and both have prior experience in life sciences as well. Regarding strategy, I think Chris summed it up well. I mean, one thing we like is the flexible approach that this fund has. They're able to take on public companies or private companies, depending on the market conditions and the position that a company is in. From a performance perspective, the fund's first fund is showing some positive signs so far. Net performance improved in the fourth quarter to above 20%. And they actually did their first sizable distribution to limited partners as well. Dr. Yu also did several deals in his previous roles, and we view that previous track record as a positive as well. There's many investments that were realized at favorable multiples. Regarding terms on the fund, many of the terms are average compared to other venture capital firms that we come across. But the fund does have a higher than average commitment to the fund, which really improves alignment with investors and limited partners. So we're recommending a $50 million commitment to TCG Crossover 2. I want to introduce Dr. Chen Yu, who's the founder and managing partner at TCG Crossover, for a short presentation, and then we're happy to answer any questions you may have.
Great. Well, nice to meet everyone on the committee, and thanks for the kind introduction. I think they basically stole all my thunder and told you everything pretty much that I was just about to say. So I think they've done a very nice job of summarizing the fund. I think in the end, what makes TCG Crossover really unique is, I think, as they noted, this flexible mandate of investing in both private and public biotech companies. Because what's very unusual about biotech is that the risk reward of investing in either side of that ledger changes depending on the market conditions. In hotter markets like we saw 2 years ago, you see most of the great opportunities in the private market because you get the step up into IPO. And in colder markets like we're living in today, you tend to see better risk reward in the public markets because valuations have corrected and the companies are a bit more mature. And so that flexibility really turned out to be very advantageous for us in the last couple of years, as noted earlier by the team. While the XBI or the biotech index dropped about 50% in the last few years, we were able to post, actually, just to give you an update at the end of the quarter, 31% positive uptick. And actually, by the end of this month, it looks like we're heading toward near 50. So actually, really dramatic outperformance. Actually, as far as we are aware, we are the top performing biotech fund in the world in the last 2 years. We're actually not aware of any other fund that outperformed us. So I think what's really exciting for us, the opportunity set ahead, is pretty much era defining. I'm sure many of you have seen in the lay press around the advances that we're seeing in biotech, gene editing, cell therapy. It's very important to note that gene editing, as an example, was only discovered 11 years ago. And yet this last year, for the first time, we're doing gene editing in patients. And so are now poised to actually legitimately have a chance to cure diseases like sickle cell anemia that before had effectively no therapies. And you can see that, frankly, in FDA drug approvals. If you weren't back pre-2010, the FDA typically approved about 20 drugs per year. And now we're improving drugs at a clip about 50 to 60 drugs per year. I think reflecting effectively that the technology that we're seeing in biotech is advancing to the point that we're just much, frankly, better at what we do. So you take a flourishing backdrop of biotech and you combine it with what I consider essentially an era-defining valuation opportunity. As noted, right now you're seeing everything is effectively 50% off. And so if you look at every valuation metric that we track in our business, they're trading at effectively all-time lows. So one classic metric is the enterprise value of the average biotech company relative to cash. And right now that ratio is hovering about 1. Meaning companies are valued at their cash and given zero value at all for their technology. And so given the renaissance that we're seeing, that's obviously not the case for many of these companies. So we are seeing a buyer's market with terms that I've never seen in my 20 years of doing this. And so, you guys are, I think, really, at the precipice of being able to, I think, frankly, time the cycle about as good as you possibly could have. So what will trigger the return? One of the key components will be pharma M&A. And one of the interesting things is that the pharma M&A activity this first quarter is tallied right now at $65 billion. It's actually on track to be the largest M&A kind of volume by total deal amount in the last 20 years. So you have really this almost perfect storm brewing, which at least again for us makes us super excited about the opportunities set ahead. So I'll just close by just saying thanks for potential partnership here. One of the great things about our business is that when we do well financially, we're also doing good. As noted, we get drugs approved for patients. And so in our portfolio in the last year, we've had 3 drugs that are now about to be approved this year. One, just as an example, will be treating geographic atrophy. It's the most common cause of blindness. And one of our companies will now have the first drug ever approved for that illness. Likewise, we have a second company that's developing a drug for something called NASH. It's the most common liver disease that we see in the developed world. Again, no therapy for it. This therapy will get approved this year. So your investment in funds like us not only hopefully will generate a great return for the state, but obviously, frankly, plays a really important societal role in making sure these drugs get developed for patients. So anyways, thank you very much for the potential partnership and support, and pause if there are any questions.
Great, thank you so much. Thanks to our own staff and Mercer and Mr. Yu for being on with us today. Any questions on this recommendation?
Madam Chair, I have 2 questions.
Madam Treasurer.
Thank you. On page, actually, it might not be the correct page because I printed this from the CIC meeting, but when we're looking at, this is for Mr. Cassidy, when we're looking at management fees, and I'm not mentioning any numbers, but on committed capital through the investment period, does that end if the money drawn down before the 5 years?
Richard, right,
So-
that's for you. Yeah.
So yeah, I mean, with venture capital, it's not uncommon to see the management fee based on commitments throughout the life of the fund. And then what we want to see is a step down in that percentage after the investment period, because they're not actively looking for new investments at that point. They're just monitoring the investments that they have. And we actually see a reduction in the percentage after the investment period down to a floor.
So the floor will always be there before or after they've used up all the funds. Is that the right understanding?
I guess the one way to say is the management fee is predictable in this case. It's not based on what investments that they have in the portfolio or not, because it's based on commitments throughout the life of the fund.
And then I did hear that there was some great performance, but I did notice on some of the paperwork we received that the funds did not have some of the information that we may have needed for an analysis. Not able to attribute the track record, so they were not able to fully evaluate the performance. Did somebody get that information after all?
No, that was referring to the prior track record of Dr. Yu. He came from a firm where, I mean, this is very common in the industry where you can't take the track record with you that you were involved with. So we spent a lot of time making reference calls to portfolio companies that he's been involved with, learning about his track record that way. And we're able to construct the performance on a lot of the deals and got comfortable with his prior track record that way.
Wonderful. Thank you for the clarification. Appreciate it. Thank you, Madam Chair.
Further questions? Do we have a motion?
Based on the recommendation of the Council Investment Committee, Consultant Mercer, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve the commitment of up to $50 million to TCG Crossover Fund 2 LP, subject and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
It's a proper motion by the treasurer, a second by member Lavender. Any discussion on the motion before the council? Can we take a roll call vote on that motion?
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Props.
Yes.
Mr. Lavender.
Yes.
Mr. Summer.
Yes.
Mr. Tejas.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-0.
Great, and we thank the representatives from TCG Crossover for being on with us today. Thank you so much. Next, we'll go to agenda item 3F, which is a fixed income investment recommendation into Silver Rock Tactical. I'll turn it over to Mr. Lofton.
Thank you, Madam Chair. We're just spending a minute here, our seating set up. Got a lot of visitors in person today.
Did you guys lose your video for everyone to see the presentations?
Madam Chair, we can't share some of these screens due to the trade secret nature of the information. And so I don't know that we're screen sharing right now.
Everything that we speak about is in your handouts. Okay, so everybody's in place. So thank you, Madam Chair. As you mentioned, we're on agenda item 3F. We're going to start on page 169 of your handout materials, your diligent materials. It's titled Fixed Income Silver Rock Tactical. This strategy for fixed income brings flexibility across a broad opportunity set, and it's managed by an experienced, knowledgeable team. Per the fixed income structure study, a key goal or key goals are structural diversification of the fixed income portfolio by strategy, underlying exposures, by manager, and so on. But also to give the ability for the portfolio to flex and to take advantage of episodic opportunities. This is a strategy today that's intended to give the portfolio that ability to flex when it needs to. So staff, in consultation with Makita, recommends a commitment of up to $300 million to Silver Rock Tactical Allocation Strategy. The Silver Rock Tactical Allocation Strategy is designed with flexibility to opportunistically, invest throughout the macroeconomic credit cycle. So joining me today on this presentation from Makita, Mary Bates. Mary, welcome to New Mexico. And then from the manager, Silver Rock, I have Andrea Boyke. Ms. Boyke is a partner in Silver Rock. She's also the global head of investor relations. I think you've been to New Mexico a few times now, maybe. So, yeah. And then we have Vinay Kumar. Mr. Kumar is head of private equity. I would like to say that Mr. Kumar, excuse me? Private credit. Private credit, my bad. That's why I need notes. My apology. I would like to say that Mr. Kumar will oversee our strategy in a portfolio management standpoint, But one of my takeaways from Silver Rock is that they're very focused on a team-oriented approach. So that's, in fact, is a key positive. In the staff memo, you will find a description of the strategy, why staff likes the strategy, its strengths and weaknesses per staff. I'm going to focus on the strategy's fit within fixed income, and Mary's going to provide more detail on the strategy and on Silver Rock. And then finally, Ms. Boyke and Mr. Kumar are going to follow up, be available for questions. So portfolio fit, the strategy is seeking to deliver 12 to 15% net returns, a 1.4 times multiple on invested capital. We're emphasizing multiple on invested capital. As Vince mentioned, the ability to recycle and grow the capital base. The tactical allocation strategy falls into the special situation subcategory of the fixed income portfolio. That category is currently within its targeted allocation. However, the purpose, as I mentioned, of this strategy is to provide flexibility, inherent flexibility within the portfolio to flex to opportunistic, flex to opportunities. And then another priority along with this is finding structures that give us the ability to recycle capital. This structure will give us that ability. So quickly on the structure with Silver Rock will be an evergreen structure. There are currently several evergreen structures within fixed income. This structure with Silver Rock will invest alongside and on a pari passu basis with the Tactical Allocation Term Fund series. However, SIC's funds will sit outside the commingled term fund in a separate structure called a fund of one, because SIC will be the only entity within that fund. The primary advantages of a Silver Rock fund of one will be the ability to recycle the capital, and it will reduce administrative costs over time. There will be no fund leverage employed in the term series or in SIC's fund of one. There will be a subscription facility to manage cash flow mismatches, but that's it. So to reiterate, staff, in consultation with Makita, recommends a commitment of up to $300 million to Silver Rock Tactical Allocation Strategy. And so with that, I'm going to turn it over to Makita. Mary.
Great. Thank you so much, Director Lofton. I'm going to keep my comments very brief in the interest of time, and Tom's already addressed a number of these points as well. So to highlight, Silver Rock's approach largely centers around creating custom solutions for companies whose use of proceeds varies from rescue financing to growth financing. The manager is active across the capital structure of companies, and as Tom's already alluded to, has the ability to take advantage of dislocations in the public markets, and will do so through the use of targeted baskets of mispriced loans and bonds when the opportunity presents itself. Silver Rock expects 75% of its return to accrue from coupon income and 25% from price appreciation, which is consistent with what CIO Smith had highlighted as a priority of the fund. Most importantly, the Silver Rock has experienced no defaults or no realized losses in its 12-year history, which gives us confidence in the yield to maturity of the portfolio as a strong starting point to think about the expected return of this program. The current yield on the program is roughly 14%, so one should have an expectation of that as a building block to grow upon. As Director Lofton has already mentioned, a 1.5 time recycling during the investment period with an average hold of 2 to 3 years. This fund does not employ, this strategy does not employ leverage and is very focused on the U.S. I'd like to just transition quickly and spend a minute talking about what we view as some of the strengths as well as potential concerns related with this strategy, as well as the associated mitigating factors. So to echo the comments that Director Lofton has already highlighted, the flexibility of this strategy, again, the ability to employ growth financing, rescue financing, working capital, as well as bespoke capital solutions across this capital structure allows the manager to add value across the credit cycle. Another way to think about this, and one of the reasons we're comfortable sizing this position in the way that we are, is we view it as an all-weather private credit strategy. We also take comfort from the manager's lack of affiliation with private equity sponsors. This is a majority employee-owned organization. It actually qualifies as a minority-owned entity. We believe this lack of affiliation with a private equity company affords it sourcing advantages, as well as its historical affiliation with a high net worth family office. So it's often viewed as quota friendly in terms of deals. We would further highlight the manager's structuring acumen, and we think that that's one of its key differentiators. Oftentimes the deal teams structure the deals so that there's upside potential as well as strong downside protection. The manager has also demonstrated an ability to find and deploy capital. That's obviously very important to make sure that the money gets put to work. We believe that ties to the manager's mid-size as well as their discipline to not meaningfully grow aggregate assets. We would also highlight that the manager has a strong demonstrated history of managing a fund of ones, and roughly 2/3 of their assets tied to this vehicle type. In terms of potential concerns, we would identify that there is meaningful key man risk associated with Vinay Kumar, the head of private credit. We would highlight that his importance was reflected in the change of the key man provision, and we would identify that as a positive. We would also recognize from a mitigating factor that his importance was recognized in his increased ownership, and we take a high degree of comfort in that. We'll let him address any potential concerns further around that. We would also highlight that the firm has experienced meaningful growth. We would highlight, however, we view this as a positive because it diversifies the client base, and we had highlighted in a previous vintage concerns about investor concentration. So in total, in closing rather, Makita believes that the Silver Rock Tactical Allocation strategy represents an attractive all-weather private credit strategy focused on capital solutions and special situations, and take comfort in the fact that the strategy dates back 12 years, and there have been no experienced loss defaults over that period. With that, happy to take questions or to turn it over to Silver Rock, whatever the preference of the committee is.
Yeah, let's hear from themselves.
Great. Well, thank you very much. We appreciate the opportunity and the honor to come in and present to you and introduce Silver Rock to you, as well as our tactical allocation strategy. I'm Andrea Boyke, joined by Vinay Kumar. You have material in your packet. I'm not quite sure what the page numbers are, so I'll just highlight the headings. We'll touch on our experienced team. So Vinay does lead our investment committee for private credit. He is part of a 3-person committee, which oversees our 20 investment professionals. As Mary has highlighted a number of the points that we'd like to emphasize, but not overemphasize to take up too much time, but we do think it's a real advantage that we focus exclusively on credit and that we do have a private equity arm. The role of our strategy and our efforts, as we have for the last nearly almost 13 years now, coming up on having initially been put together in 2010, is that we work with sponsors, owners of businesses, entrepreneurs to fund their next initiatives and find creative ways to build out the appropriate strategies to make such special situation investments. So the way we structure our team, if you look at the experienced team page, is that our professionals focus on sector coverage as well as strategy coverage, and work collectively, since ownership is broadly based and our alignment is with our investors, to also cover broad sponsors, restructuring professionals, and advisory organizations. As we turn to the next page, which is the dynamic investment approach, Vinay will go into this to discuss our hybrid approach to investing through a full credit cycle. We've obviously seen a number of them in our 12+ years, and how we invest differs based on the point in which we are in that cycle.
Absolutely. Thanks very much. As you can see here, we really pride ourselves on finding opportunities throughout the entire credit cycle, and those opportunities will differ over time. We've run this strategy for about 13 years through different cycles, and so we've seen how various points in the economic cycle can create different opportunities. If you please flip to the next slide, you'll see our 5 core sub-strategies. Not every one of these strategies will be present at all phases, but we have the ability to cycle between them. And really the core driver is around risk management. What we're focused on is downside protection of all of our investments and making sure that we have partnership and alignment with the owner of the business, whether that's a private equity firm, an entrepreneur, or even a broad-based shareholder group. We really want to have active involvement with the companies, both when we're structuring the transaction as well as afterwards. You'll often find us on creditors committees or in some cases with board observer seats. This is a yield-oriented strategy where we're focused on investing the capital over a 3-year period. The average hold is typically between 2 and 3 years for a given investment, and we're targeting a 12 to 15% investment return.
In the interest of time, what we can take a look at is the opportunities that we see, or at least address those as questions, which would be here under the market opportunity set. But if we now look at just the executive summary, maintaining that time, is this idea of reinvesting. We do have a current 14% coupon income in the portfolio. We take that, reinvest that through the 3-year time period, as well as any realization that we see. So you'll notice that the current commingled fund already has had a reinvestment ratio of 162%. So that means that we've outpaced that reinvestment period. That really contributes to the point that CIO Smith had mentioned, which was compounding. So it's important to have that ability to reinvest that capital, redeploy that. So essentially the assets that are committed are used at least 1.5 times with that balance between MOIC and targeted IRR. As you see here, we tend to have between 20 and 30 names in each portfolio. And after that investment period is concluded, then we distribute on a quarterly basis during a 2-year harvest period. Hence, it's a 3-year investment period, 2-year harvest, 5-year term fund. That would really bring us to the end of our comments. For questions, we're sensitive to making sure that there's information that you might want to ask about.
Great. Thank you so much. Thank you to our team, Makita, and the folks that have joined us from Silver Rock. And now we'll open it up to questions from council.
Madam Chair?
Yes.
A few questions and comments. I wish I would have been there in person to meet Mary. So it's nice to see you there. I love reading all your material. Big fan. So quick question, and I think this is mostly on Mary's presentation. On the no-fault termination for rating comment, it says negative. The presence of any form of a no-fault termination is typically viewed as a favorable for LPs. I didn't understand what that meant. Can you help me out? Or in general, what that might mean, or is it relevant?
Yeah, I do.
This is Paige.
Evan has stood up to answer what the no fault is.
Having not read that, I can tell you what it is, though, I think.
Yeah.
Okay.
So in most private funds that you'll see, alternative investment structures, there are both fault and no fault terms in terms of if you needed to get out, for lack of a better word. No fault is generally a positive additional term for investors because a certain number of investors vote that they don't like where things are going. You can probably get out at least over a period of time. Here, because you have a fund of one that re-ups every so often, it's sort of the equivalent of a no fault whatever, because you'll make that determination as a rebalancing matter, or rather staff will pursuant to this mandate that you have. So basically you have exit opportunities that aren't driven on some sort of malfeasance, and there's effectively more liquidity, albeit I assume this is quarterly, over 2-year kind of, there's a delay in when this is totally liquid.
Thank you. And
Madam
Madam,
Treasurer?
that answers it. And because staff is always hearing me talk about management fees, I will say that on this one, I was very happy to see what I saw, including the option of looking at some other things. I don't know how much I'm allowed to say, but I appreciate that. The last question I would have is, Carl Meyer, is he still part of you guys?
Yes, very much so. He's a member, as you'll see on that earlier page, of the investment committee.
I did see him on the exhibits, but there was a concern raised about, and I didn't quite understand it, but I just wanted to make sure everyone was still intact. That's all I have, Madam Chair.
Further questions?
I'm really excited about this one. If there's no other council questions, I'll do a motion if you're okay with it.
All right, we're ready for a motion.
Based on the recommendation of the Council Investment Committee, Consultant Makita, SIC staff, and General Fiduciary Oversight of RVK, I move that the State Investment Council approve a commitment of up to $300 million to Silver Rock Tactical Allocation Strategy, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork, and Mary's presentation.
I'll second. Yep, all of us.
All right, we've got a proper motion by the treasurer. Second, I believe, by member Lavender and member Summer. Any discussion on the motion before the council? Can we take a roll call vote on the motion?
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Prop.
Yes.
Mr. Lavender.
Yes.
Mr. Summer.
Yes.
Mr. Pettis.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-0.
Great, and we thank the folks from Silver Rock for being with us there in person.
Thank you.
Thank you.
Next, we'll head over to agenda item 3G. Under real estate and real return, we have an investment recommendation for Oak Tree. And I'm going to turn it over to Mr. Sable.
Great, thank you, Madam Chair. The content for this portion of the presentation begins on page 249 of your board books. I'm joined by Townsend online today, Seth Marcus and Rob, coaches there, and then from Los Angeles, I believe, Lauren Gribble, SVP of Marketing for Oak Tree, and Ambrose Fisher, co-PM on the strategy. We're here to make a recommendation to commit up to $150 million to Oak Street Real Estate Opportunities Fund. This is an opportunistic equity and distressed credit strategy that will reside in real estate's non-core opportunistic bucket. This is going to be Council's first investment in this fund series, and with this GP, the fund is targeting net returns in the mid to upper teens. In terms of brief history of the firm, Oak Tree is a Los Angeles-based firm and is a leading global alternative investment manager with about $170 million in AUM at year end. The firm was established in 1995 when 6 co-founders left TCW. Subsequently, they IPO'd the company in 2012, and then after that, Brookfield Asset Management, another of our GPs, purchased a controlling stake in 2019. As of the end of last year, Brookfield owned approximately 2/3 of the company. Oak Tree's built a really strong reputation as a distressed credit investor. These roots are reflected in the GP's approach to the real estate business, where it emphasizes stressed and distressed access to real estate. The GP's reputation and scale have made it a go-to buyer in distressed circumstances, providing it an edge in sourcing attractive deal flow. Oak Tree Real Estate Opportunities Fund 9 will seek to leverage Oak Tree's distressed investing skill set by targeting opportunities to deploy capital through purchases of distressed debt, discounted securities, providing rescue capital, or participating in equity recapitalizations. Staff believes that the market opportunity is ripe for a well-resourced manager with a flexible mandate to pursue opportunistic real estate investments.
Well, only the tip of the iceberg. The redemption gates that we're seeing at the non-traded REITs are indicative of the stresses that exist in the system today. A lot of the catalyst for this stress is the rise in interest rates causing declines in asset valuations. Alternatively, that's an increase in cap rates, and it's coupled with generally tightening credit conditions. Combination of these factors is creating a situation where it's really difficult to sometimes nearly impossible to refinance properties, so the stress creates an opportunity for the GP. Some sectors of the real estate market are experiencing negative leverage. That's a condition in which borrowing costs are higher than cap rates. That implies that absent really strong NOI growth, a lot of transactions only make sense for equity financed buyers. Again, another good opportunity for Oaktree. Finally, we're also seeing situations where some equity sponsors are handing the keys to their properties back to the banks, and the banks themselves are seeking to manage balance sheet risk. And so the combination of these factors makes the market opportunity set look particularly rich. In terms of market performance over multiple vintages, this fund series has performed in line with its opportunistic peers. We view this as a positive because the fund is tended to be more broadly diversified and a more conservative user of leverage than its peers. We do note, looking at the track record, that vintage years corresponding to significant market stresses have produced better returns than those in more stable market environments. And we believe that to be the case because we think that the alignment of manager competencies is stronger during periods when there is stress in the marketplace. In summary, we believe we've got a strong manager, a great strategy, and very favorable market conditions. With that, I'll hand over to Seth to present Townsend's underwriting.
Thanks, Keith, and good morning, everyone. So, look, I think that Keith covered this very well, so I'll do my best not to reiterate or repeat anything he said. As he mentioned, this is a new manager for the SIC's real estate portfolio, and as you know, we have a very well-established, mature, and diversified portfolio, which makes adding a new manager and a new strategy a very high bar. However, we're consistently evaluating different market opportunities beyond your just existing managers. And to that point, in this case, we believe Oaktree really represents a strong opportunistic equity and credit distress investment opportunity at a time that when the strategy is uniquely attractive. Keith walked through the strategy in detail, but basically, to boil it down, the fund will make real estate investments throughout the capital stack. Our belief is early in the investment period, the opportunity is likely to focus more on accessing opportunities through the debt positions or leverage the debt positions of a distressed opportunity. And as the market rebounds, direct acquisitions will be more attractive. Oaktree is uniquely positioned to access the real estate throughout those different access points, and has done so throughout their tenure and throughout their history. From a New Mexico portfolio construction standpoint, this investment would sit in our non-core opportunistic portfolio. When we think about investment pacing, you heard a lot about the growth of the portfolio or the growth of the total plan today. We have used the strategy team's assumptions into our model, specifically the data that Dawn had presented earlier. And based on this, our 2023 pacing calls for approximately $750 million of new non-core capital to move towards our 12% target and maintain our core non-core targets over the next few years. This proposed commitment, as I mentioned, will be in the non-core space and be our third of the year, representing $350 million across those three commitments. When we think about why we're recommending Oaktree and how we got to this decision on investing with a new manager and a relatively new strategy for the portfolio, it is the deep and overall depth of the platform and the resources of the Oaktree organization. They're not just a real estate investor, they invest across different private asset classes, and that gives them a unique insight into new opportunities and sourcing, and also underwriting investment opportunities during times of distress. The investment flexibility during these market conditions also leads into our recommendation and the ability to do this over a consistent track record. Lastly, and not a reason we ever make an investment, but fees are attractive in this commitment. New Mexico will benefit from a lower fee due to targeting the first close. Additionally, Townsend has negotiated with Oaktree the ability to aggregate our client capital across all clients to for a reduced fee that's noted in your presentation. So I spoke briefly here, and I'll hand it over to Oak Tree, but happy to answer any questions after their presentation.
Terrific. Good morning, all. I'm Lauren Gribble and have the pleasure of serving as the Council's primary Oak Tree contact across strategies. We were thrilled to bring you on as an Oak Tree client in 2020 through your commitment to Opportunity Fund 11, which is our flagship credit fund. Through that investment and some of the comments both Keith and Seth made, you likely learned that Oak Tree is known for being a pioneer in distressed debt investing. Today, we will present how those roots really apply to our real estate fund we are currently raising, Real Estate Opportunities Fund 9. I'm joined here by Ambrose Fisher, co-portfolio manager of the Real Estate Opportunities strategy. Ambrose's time with the team dates back to Oak Tree's founding in 1995. Thank you again for your consideration, and feel free to jump in with questions.
Thank you, Lauren. Thanks, Keith. And thank you, Seth, as well, for the warm introduction. Sorry we couldn't be there, or I couldn't be there in person. I'm actually over in London working this week, so I couldn't be down there, but look forward to meeting you in person at some time in the future. As Lauren mentioned, my name is Ambrose Fisher. So I joined Howard & Bruce back at Trust Company of the West in January of 1995. They had just raised what they called Special Credits Fund 6, the Distressed Mortgage Fund, and we're building out a real estate team. And so I was the fifth person hired back then as the analyst on the team. A couple of months after I joined Howard & Bruce at TCW, they resigned to start Oak Tree, and we followed them over. So I've been working now with Howard & Bruce for over 28 years. This is my sixth distress cycle investing with them. So we are very excited about the opportunity set that's in front of us. And maybe we'll just flip a couple pages in the brochure and talk about really the team, and then just talk a little bit about the opportunity set. So we run an integrated real estate platform, which has about $27 billion of committed capital in it. Our opportunistic business is our flagship business, dating back to that fund that we raised in 1994 at Trust Company of the West. We also in 2010 started a performing debt business, which came out of we were one of 9 managers selected by the US Treasury to run one of the public-private investment programs, the PPIP programs, during the global financial crisis. And our performing debt business really spun out of that victory, where we drove the highest IRR for what ended up being 8 participants in that program. And then finally, our newest business is a real estate income business that we started in 2016. And we really think it's important to run the 3 as a consolidated business, because at different points of the cycle, you're really leaning on the skills and expertise, whether it's sourcing or underwriting or purchasing different types of assets, because you can't always do the same thing, because in different points of the cycles, you have to be doing distressed credit versus real estate growth investments that we can touch on. So in the opportunistic business, we really do 5 things. The first is what we call opportunistic credit. That's really just investing in existing credit at discounts or distress to make equity returns. So that part of the business is really only available during the distress part of the cycle, and not available when credit flows freely and you just make a fixed income return from credit. We also invest in commercial real estate, and that's what are generally thought of as kind of the big 5 areas, being multifamily for rent, industrial, office, hospitality, and retail. For us, we break out residential, which is for sale residential, so think single family homes. We also invest in corporate platforms, so that's just the wrapper that the real estate comes in. And then finally, we do global ex-US investing, so we are a global fund and have teams on the ground in New York and Los Angeles. LA is our headquarters for US. And then in Asia, we invest across our 4 different offices in Seoul, Tokyo, Hong Kong, and Sydney. And in Europe, we invest in the UK Pan-European out of our London office. We really have a very deep, experienced team. On the real estate side, we have 61 investment professionals. We're the largest group at Oak Tree. We have 22 managing directors with an average of 23 years experience across those managing directors. And it's really this team that has been leading the business since our Roof 4, which was our global financial crisis fund that we raised back in 2008. And we've invested about $50 billion of capital out of our opportunistic vehicles in 377 transactions since that 2008 vintage fund, generating an average 1.7 multiple of capital, actually across the entire business over the 28 years. So we're very proud of the fact that through multiple different cycles, as I mentioned, this is my 6th, we've been able to invest profitably across all parts of the business cycle in our opportunistic business. And then what are we excited about now? What do we think we're sort of, what gets us excited about the opportunity for Roof 9? And it's really the fact that interest rates have risen dramatically as the Fed and other global central banks have had to tighten credit conditions and raise rates to tap down inflation. That's causing a decline in value across the real estate assets. You know, we invest both on the liquid credit side, doing that distressed debt, but also on the growth side. So if you think back to a year ago, before the Fed started to raise rates, credit in that 50 to 75% loan to value was trading at SOFR plus 200, or call it 2 to 3% returns. That credit has now gapped out and is now trading at 10 to 15% returns. So all of a sudden you can make really good money in credit. So we think the opportunity in front of us today is mostly on the credit side for the here and now. Although at some point, once credit starts to loosen and we see where interest rates end up, and we also see where the fundamentals end up going, the private side of real estate will get more interesting. Right now, it's really about the liquid side. The private side is very much shut down, even for favored asset classes like multifamily for rent and industrial or logistics buildings. There just is not the depth of bidding that there was over a year ago, as people are trying to figure out where interest rates and cap rates are going to go, and fundamentals as well. Because typically when you see a credit tightening cycle, about 12 months after the central banks start to tighten, you then start to see a slowdown in the economy and GDP. And it's typically another 12 months after that where you start to see the fundamentals in real estate deteriorating, because real estate tends to be a laggard. So we think we are in the early innings of a reset in real estate. Fund 9, because we have no legacy assets, will get to participate in, you know, the restructurings, the recapitalizations, and the decline in value, while many other sort of long-only real estate investors will see their portfolios decline over time as rates settle out wherever they're going to settle and values continue to probably come down. We will be able to take advantage of that in Fund 9. And hopefully generate similar returns that we generated over our 28 years. And with that, I'll pause and see if there are any questions.
Great, thank you very much. We're going to go to questions from council. Any questions on this investment?
Madam Chair?
Yes.
Question, and I think it's for Seth. Great presentation. Nice to meet you all. Seth, can you just give me a rundown real quick on the incentive fee waterfall?
Sure. So let me just pull up my. So the management fee quoted in your report is outside of that, right? So you have the management fee that you pay on an annual basis. The incentive fee waterfall, just so to understand how that works, you receive back a full return of capital, plus a return, plus all of the fees that you've paid, and then you receive an 8% return. Once you receive that 8% return, then there is a split between a share goes to the GP, the manager Oaktree, and a share goes to you, the LP, until 20% of the profits are received. And that's a little bit of an outsized share to the GP, a 60-40 split there. And then thereafter, very typical, the share beyond then is 80% to the investor and 20% to the GP. What's very interesting and what's positive about this structure is that it's on a fully pooled basis. So what that means is not one individual, you don't pay this fee, or the incentive fee is not earned if one specific investment produces an outsized return, but the whole portfolio has to generate that total IRR before the fee is paid.
Wonderful, thank you, appreciate it. Thank you, Madam Chair.
Anything further?
Would you like me to make a motion?
Okay.
Based on the recommendation of the Council Investment Committee, Consultant Townsend, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $150 million to Oak Tree Real Estate Opportunities Fund 9 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
All right, we've got a proper motion by the treasurer, second by member Lavender. Any discussion on the motion before the council? Can we take a roll call vote on that motion, please?
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Prost.
Yes.
Mr. Lavender.
Yep.
Mr. Summer.
Yes.
Mr. Tejas.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-0.
Very good. We thank the folks from our team, Townsend and Oak Tree, for being on with us today. Thank you so much.
Thank you.
All right. With that, we're going to move to agenda item 4A and turn it over to member Tejas for his comments on the audit committee.
Yes, Madam Chair. We met with the audit committee on last Thursday and reviewed some of our audit planning. We went over the investment holdings report with Brent, and he presented to us on the budget that you have in your packets. And I think he'll go over that here in just a second, but that's about it.
Thank you very much. Is Mr. Ship ready for the CFO report, agenda item 4B?
I am, Madam Chair, and I'll be as brief as I can. Just a couple of points, if I may. I'm on page 313 of the material. I just wanted to point out, because I've gotten some questions on the third item there, which is the agreed upon procedures. And I just wanted to emphasize to the committee that the agreed upon procedures that are done quarterly are done basically completed because of statutory requirements. And I just wanted to assure the council that probably the first thing the auditors do when they complete these quarterly agreed upon procedures is get information from our custodian bank, make sure that they can actually tie out the populations of the purchases and the sales of the various transactions that appear on JP Morgan's information. And that tie out of the population is the key to everything they do. Before you do any sampling of any nature or any type, you always want to make sure you have a complete population, and that's what they actually select their samples from. These samples that they test on a quarterly basis includes not only the public investments in both the equity and the fixed income areas, but also includes the contributions and distributions as it relates to the private investment. I have no comments today on the budget other than the fiscal year 23 budget, other than to say I don't think we will have any problems making it through the end of the fiscal year. The investment holdings report is a quarterly report. I just wanted to emphasize to everybody within that report, not only do you have a snapshot of the various funds that we've talked about earlier today, but you have a roll forward on a monthly basis and a quarterly basis, so you can see tying out to those individual snapshots how they've changed on both a monthly and a quarterly basis. And then lastly, I just want to highlight on page 388, this is the, let me thumb over there, this is the preliminary budget for fiscal year 24. want to emphasize to the council that the fiscal year that we're completing right now, we have basically a couple of months plus to get through fiscal year 23. This is the budget for fiscal year 24 that begins on July 1st. Just want to assure the council that this budget aligns the appropriation request that was approved by the recent legislature. You'll note that it's divided into 3 categories, as is our normal budget, the 200s, the 300s, and the 400s. If you look within the 200 category, the top 2 lines of that schedule is both GovX and the classified employees. Those are the biggest amounts that we spend within the 200 category. If you kind of go down to your right, you'll note the largest expenditure other than salaries is the retirement contributions. That contribution on the employer side is approaching close to 20% for fiscal year 24. And then within the 300 category, as you would expect, professional services is by far the largest category. Want to, as I've done in the past, emphasize that the fees that we pay the public, both fixed income and the equity managers, come out of this amount, as well as amounts paid to our consultants, as well as other fees for advisory type services that, like the one Mikhail presented today. And then lastly, I just wanted to show within the 400 category, the largest expenditure within that category is the rent of our building. We are currently undergoing a review of the lease, which is up as of the end of July. So within the next couple of months, we will have a presentation on actually renewing that lease for another 5 years. Did want to emphasize within this schedule, it does say preliminary budget. It's only preliminary because we possibly could tweak these numbers a little bit. The category totals are going to be the same, but we're still waiting for some final information from DFA and others to make sure that we can actually finalize this and get it submitted. Other than that, the only other item within the schedule I wanted to make comment on is the budget adjustment column. You see $262,100 there. That amount relates to the raises that the governor has signed off on. I think it's 5% plus another 1% for insurance premium increases. So that is an amount that we don't control. It is talked about and approved at the legislature level. So that's the reason it's kind of a separate piece outside of our normal appropriation request. Other than that, that's all the comments I had on this fiscal year 24 preliminary budget. I'm happy to answer any questions if there are questions. And that's all I have.
Thank you, Mr. Shipp. Any questions? Hearing none, we'll move to agenda item 5. Any old or new business before the council? Hearing none, our next SIC meeting will be Tuesday, the 23rd. I believe the location is still TBA. And next we'll move to the public comment period. We'll ask Mr. Woolman if there's any guests that are in person or public comment that was turned into the council ahead of time to be read.
Madam Chair, we are without public comment today.
Okay, and finally, a motion to adjourn.
So move.
Okay, we have a motion to adjourn, and with that, you're adjourned. See you next month.
Thank you all.
Thank
Great
you all.
meeting.
Bye-bye.
Good job, staff.